lessons from the global stage and insight for the Nigerian insurance industry. Welcome to the stage. Thank you.
Please a round of applause for him.
Good morning, everyone. Are we all happy to be here? Okay, so it's always very difficult when people just finish eating and then you now need to listen to lectures, especially lectures that might not be within our comfort zone. So today we are not going to talk about models, we are not going to talk about actuarial science. We just want to talk about, we are going back into the history. As you all know, the theme of the conference is creating value and building resilience, in an evolving industry. So basically what we wanted to do was just to talk about family-owned, owner-managed insurance companies. The question then is, why insurance companies? Most of us traditionally, work in, insurance firms and all. So what we try to do is basically to, look at how owners, people that have had that vision, how have they been able to, weather the storms, how have they been able to be resilient about their business. So basically, what they've done is that they've built on bloodlines, and those companies have been tested over time. So what we are going to talk about here today is just for us to look at. We explore what makes family-owned insurance company very strong. We also look at. I'll provide insight into some family-owned insurance companies. So what I've done basically is to look at insurance company from Europe. And then I came back to Africa, South Africa, East Africa, North Africa, and West Africa, and more specifically to Nigeria. We also look at cases of setbacks, and the reason why those companies had such setbacks. So I don't want to say that those companies have failed. Maybe that would have been an appropriate word, but I just wanted to say setbacks so that it doesn't bring so much controversy into the discussion. And basically, we'll take our lessons, with regards to sustainability, adaptability, and competitiveness. Okay. So basically, we all know, family-owned insurance company. They are basically insurance company, that is privately owned. Most of them have actually metamorphosed into public-owned entities. But what you see basically is that there is always a strong man who can be just one person, or a family or group of people, coming together to say, we'll put our money where our mouth is, and then we'll support this company and grow it. So I will probably be interchanging the word family-owned business with an owner-managed insurance company as well. So because those ones also fall into that categories. So unlike other companies, these businesses are passed down through generations. So what we see is that most of these companies have been around for a while, and you tend to see one name that is very synonymous to some of these companies. Also, one of the things that I also, get fascinated about these insurance companies are that, they offer personalized service, and they also relate to some communities. So you see, one of the things that they also pride in is that when they have their customers always relate with them, based on the fact that, these are our community-owned insurance companies, just like in football as well. You see you saw football companies as football teams where they are more localized, and the communities tend to sort of relate with them the more. So basically, what are the key characteristics of these companies? Like I said, the ownership and management is very clear. Sometimes there can be a separation between ownership and management, but most of the times, the ownership and management are always, fused together. In terms of service, they are more personalized. That is when you see that, customers will always want to relate with that one man, and then that man can easily just make decision so that, it doesn't look as if we need to go through some, route for us to make, a very small decision. So they are always very personalized in terms of their service. For commitment engagement, like I said, they are more relatable to a community. I have some few examples where I will be able to talk about the environment with which they were established. And some of these companies have actually stand the test of time. They've been around for a while. Okay, so basically, we'll look at the strength of these companies. Most of them, when they were established, the owners, the proponent of these companies have a very long-term vision. They wanted this company to even, outlive them, and that is what we've seen over time. In terms of strong corporate culture, this is, neither here nor there, but most of the ones that have been around for a while, they also have that strong family culture, where you can easily relate the company, to the family involved. In terms of decision making, we all agree that they are always very fast in terms of decision making because they don't need to go through all those various routes in making their decisions. And so, because they are more like a community-based companies, the company were able to trust them. The company were able to relate more with them, and they've also been able to build trust within the community with which they operate. Like I said, they've weathered so many storms. Most of them have failed. Most of have failed, and they've come back. And so they've also gone through so many economic situations. Some have had issues with regulators and all. So, but in all of this, they've been resilient. Those ones that are still available, they've been very resilient, and they've been able to weather the storm. Okay, so. What I wanted to do now is to probably just look at various examples of these companies. Going to start from. So for this, I have 3 companies that I'm going to showcase here. The first one is a company called Talan. Pardon me, I might not be able to get some of those names. So this company was formed in 1903 in Germany, and the Grote family, are the proponent of these companies, and they've been around for a while. These companies still exist. Currently, they've acquired so many businesses, and the prominent among them is Hannover. We all know Hannover. Hannover is a very a German reinsurance companies, and they've been around for a while. So this company, this family, the Grote family, has actually put their hands into this business. They've also had a very varied companies. Aside from the insurance company, they've also gone into financial services. They are also into banks and all. And they have about I think they have there's a company called Retail Insurance. They deal with they operate in the retail space, and this company also own that retail insurance as well as Hannover. This is a company in France, and this company is probably the only family-owned insurance company that is still existing in France. This company was founded in 1829. And the key person behind this company is Olivier Jaillon. This company has also gone through a whole lot of modernization. They are a niche insurer because they've been able to create some sort of niche for themselves in parametric insurance. They also deal with digital solution, and also they've been able to bring about some innovation in underwriting models. And lastly, for this is Generali. We are all familiar with Generali. Generali is a company that is synonymous with Italy. This company was also formed in 1831. And this company was founded by Giuseppe Lozaro. One thing about this company is that this guy does not really have the wherewithal to establish this company. So what he did was that he team up with some financial experts, and they all contributed. They brought in some funds to actually establish this company. And this company still around, and all of these companies are still around basically. So just to tell you that, this company has gone through so many, economic recessions, and yet they are still standing. Most of them have actually, diversified into other industries aside from insurance. So, if you now come back to Africa, everybody will be able to relate with Sanlam. Sanlam is a company from South Africa. This company was founded in 1918 as a life insurance company by a group of African businessmen. And prominent people, in the formation of Sanlam was Jan Maris, Van de Jebel, and the Rupert family also played a very significant role in Sanlam. So now this company is already listed, and that was what I was saying when I was talking about evolution of most of these family-owned businesses, because they know that the only thing that can actually sustain them is for them to sort of move away from the traditional one-man show and also get themselves listed. Most of them are listed. One of them is Sanlam. Sanlam is already listed, but they still have that strong African communities, and everybody, within the South African ranks, so some sort of relate with Sanlam. So they've evolved into Africa's largest financial services group, and they operate in about 30 African countries. They are also here in Nigeria. In terms of the family legacy, the early structure was actually, influenced by cultural and community ties. I've spoken about this. The Africans, were the founder of these companies, and so people around them were able to relate, with that. There's also the part of the family-like ownership, where everybody believes that, once it's ours, it's just, and also they've also been able to use relationship-based business. So the thing is that because we're able to relate more, on one-on-one, you're able to get, much more long business. And then the owners also had some long-term thinking, because they want this company to outlive them, and that was what they've, been able to do. And that is South Africa for you. Moving on to NIC. NIC is actually a company in East Africa. This company was founded in 1972 as National Insurance Corporation by two Kenyan family, James Ndengwa and Peter Kairuki. Peter Kairuki family, is actually a prominent businessman in Kenya. I think one of them was actually a former central bank governor in Kenya. So they started as a small insurance agency. They offer general insurance product. From there, they provided insurance solution to Kenya growing middle class and businesses. Right now, they've expanded into banking. And in 1990, they established NIC Bank, now NCBA, after a merger with CBA Bank. And this diversification has allowed them to, offer integrated financial services. So aside from the insurance business, they've also sort of expanded into the banking space. In terms of regional presence, they've expanded, out of Kenya, and they are now, in East Africa, including in Uganda, Tanzania, and they become like a regional leader in the insurance sector in East Africa. So the founding family actually maintain a very strong presence on the company board and in its governance. So this has influenced, their influence has been instrumental in maintaining a long-term focus on customer trust and innovation. So basically, what I was trying to say here is that when you have a vision that you need to, when you have a vision that you need to, do something. So when you have a vision that you need to do something, there is need for you to, not look at the short term, but look at basically, the long-term nature of it. This is also another company in East Africa, Phoenix. Phoenix of East Africa was founded in 1960 by Tanzanian entrepreneurs. And these are two key families, that I was able to identify with. Jakaya Kikwete was the former president of Tanzania and is a notable member of the founding family. His involvement in the company has actually helped shape his focus on community service and local development. Because people were able to relate with him more, they were able to also patronize the company as well. So like NIC, the owners, the founding fathers also had some sort of influence, on the company. This is a very interesting company that is dear to my heart, Britam. Britam is a company in Kenya. It was founded in 1965 as a branch of British American Insurance. So Britam is not really a wholly owned family insurance company, but what actually happened was that they have a CEO, you know, that is more relatable. You know, I mean, the CEO so the CEO carried the brand of the company, and that this CEO, you know, was also very instrumental to the growth that we've seen in Britam. So, like I said, it's not strictly, you know, a family-owned insurance company, but, you know, the CEO has actually put himself out, and he has also shown, you know, leadership as far as the company is concerned. And they operate in multiple East African countries. One thing about Britam is that, you know, they've sort of expanded into the retail space. There's a company that they established. That company is called Britam Connect, who also does micro insurance. You know, they've been able to, you know, leverage technology, and they've gone into agriculture. You know, they've almost taken micro insurance to some level, and that is Britam for you. The CEO actually, you know, sort of drive the company from within. I remember when we had a session with, you know, one of the Britam executive that was actually driving the microinsurance field, and the question we posed to her then was that, how have you guys been able to, you know, sort of move the company from where they are to where, from being a traditional insurance company to a company that has actually grown, you know, their microinsurance space? And she said that for them, they understand the fact that looking at the traditional insurance space, it might not be more suitable for a micro insurance. So what they did was to actually, you know, take out the micro insurance operation from the traditional insurance space and then grow that organically. So what they've done was that they took out some staff, about 5 or 7 of them, you know, and they allowed them to operate, you know, independent of Britam. And for them, decision is much more quicker. They are able to service their client more, and that can only be done if you have someone that has, you know, that agility, you know, that can actually make that decision as quickly as possible. Okay. Next one is Sam. So the history of Sam is, you know, a bit peculiar, because Sam was a Moroccan company before now. They were founded in 1979 by Lamrani family. Lamrani family is one of the Morocco's most prominent business family, and the key person in that family was Maoulé Afid El Lalami. He's a Moroccan businessman, and so he has been able to use his influence to sort of, you know, expand Saham across African countries. As we speak now, Saham is now a member of Sanlam, you know. So Sanlam bought over Saham at some point, and that was when they went through, you know, the transition that actually allows Sanlam to buy over Saham. So what did they do well? You know, they have a leader that is more focused, that is more forward-oriented. They also, you know, try to grow out of where they were. You know, they've moved into other regions. They grew into about 20 countries, responding to local dynamics and forging small partnership. They've also been able to, you know, diversify their business by building a vertically integrated group across finance, healthcare, and, you know, other services. And also, because they are sort of the populace could relate more with them, you know, they were able to sort of grow customer trust and also prioritize long-term relationship. And so there's also one thing I wanted to say about, you know, all these family-owned companies. I think one of the mistakes that we've made in the past is the fact that if I have a business and I feel like, you know, people can relate more with me, with this business, we tend to want to, you know, let it be, even when we know that this company is not doing well. So what this company has done was that at a point, they took a decision to, you know, exit the business. And what did they do? They allow, you know, other insurance company that is more stronger than them to come into them and buy, you know, the company up. And that was what they did with their strategic exit. Okay, moving to West Africa now. The first company is NCIA. I mean, we could all relate, for us in Nigeria, we could all relate with NCIA. But we all know that NCI actually came from Cote d'Ivoire. It's a French company and was founded in 1995, in Cote d'Ivoire. The Diago family, has retained significant influence over this business, and they still do. In terms of current leadership, this company has transited from father to son. The father was Jean Kako Diago, while the son is Jean Daniel Diago, who currently runs the group. So that's to tell you that most of these businesses have actually, transit generations. And this is one of them. They currently operate in over 12 African countries in West and Central Africa, including, we have their presence also in Nigeria. Like I've said, these are what I've looked at in terms of their success factor and how they've been able to, excel. Visionary founding and succession, that can be seen, where we have power transiting from father to son. In terms of regional growth, they've also been able to grow out of, Cote d'Ivoire into West and East Africa as well. Cultural brand alignment, the African-rooted companies, customer-oriented, and people within their locality can actually trust them. And they've also, been involved in some training, talent development, local empowerment, as well as leadership development. So they've been able to, sort of balance their growth in terms of blending family control with institutional governance structures. Okay, so Regency name. Regency name is, this company is somehow very dynamic, because we all know that there is a company in Nigeria called Name, right? So Regency name is a company that operates from Francophone West Africa. And this company is actually owned by Regency Nigeria and Name Insurance in Nigeria. So when they established this company, they merged their name. In Nigeria, they are, they used to be separate companies, right? Okay, so this operate from Francophone West African countries. They have, strong local family control and is involved in multiple sectors beyond it. So the reason why I bring this company is also the fact that some managers, that have been asked to, sort of manage insurance companies, and they've seen the potentials, also, find a way to sort of establish insurance companies. So these companies were actually, established in Francophone West Africa by managers of the Nigerian-owned entities, even when the Nigerian entities are not family-owned companies. Okay, so they are known for fostering community trust and long-term relationship. And these are the key strengths that I've noticed about Regency name in terms of trust and reputation. They are rooted in family values and long-standing relationship with clients and brokers. As we speak, the Nigeria entity, are individually, doing fairly well. I mean, if I'm to separate the two insurance companies, one is, doing fairly well, and the other is really not, not doing too well. But, you can see the synergy, that they've displayed in other countries where they were established. In terms of local intelligence and stability, they've been able to, navigate regional challenges with insight and prudence. Maybe we can say that with the Nigerian entity or not. I mean that is also debatable. Okay, so moving into Nigeria. I mean, everybody can relate with this. This is, a classical example of a Nigerian-owned family insurance companies. And there's no doubt this is a frontline insurance company in Nigeria. It was established in 1970 by Sir Dr. Hassan Odukale, and we know that this company has gone through, a whole lot of transformation. And I mean, we are all happy, to relate with Leadway, as a Nigerian brand. And current leadership, we now have Dr. Hassan Odukale's son, Tunde Hassan Odukale, as the GMD CEO, and the ownership still remain under the control of the Hassan Odukale family. One of the highlights that I picked was that this is one of the largest and most reputable insurance company in Nigeria. I don't think anybody can argue that. They offer life, general, and investment-linked insurance services. They've also, extended into hospitality, into HMOs, and even pensions. Yeah. So, you can also praise them for corporate governance, digital innovation, and long-term planning. I can say that this is one of the insurance companies that started digitalization in Nigeria. Right now, this company still remains a privately owned insurance company and is one of the top 3 insurance companies in Nigeria. Okay. So I bought Custodian not because Custodian is a family-owned insurance company, but Custodian is a company that I can say is an owner-managed company. This company is very dear to my heart because this is where I started my own insurance career from. The company was established in 1997. The parent company is Custodian Investment PLC. So they now have an holding company. Proud to recapitalization. It used to be, a composite insurance company. When they couldn't meet recapitalization, they had to let the life arm go. And I remember it was Leadway, that they seeded that life portfolio to. And then they went on, doing general insurance business at some point. Custodian is one of the companies that has successfully done mergers in this market. That was when they acquired Crusader Life Insurance. So that was when they now brought back, the life insurance company. So this was a company that couldn't, raise enough capital to, to manage a life arm when recapitalization was done. But after the recapitalization, they were not able to buy another life insurance company. So as we speak now, Custodian has, as part of their subsidiary, they have the general insurance business. They also have the life insurance business, courtesy of the merger that was done between acquisition, actually, between Custodian and Crusader Life. Wole Oshin is a prominent figure. We all know Wole Oshin. This company is publicly traded. And Wole Oshin still remains a major shareholder, an influential figure, serving as group managing director. So, like I said, it is not really classified as family-owned business. But what Wole has done is that he has put his weight, behind this company, and this company has grown from, strength to strength over time. Having been the first company that I know of that has actually, done a merger in this market. So in terms of strength areas, I look at Wole long-term leadership structure. He's been, with this company for a while, and the brand has always been, that. In terms of his entrepreneurial agility, he's focused. Wole can take decision quickly. He doesn't need to, go through all the bureaucracy within an organization for him to take decision. And so, decision making in Custodian is, a bit fast. In terms of focus, he has so much influence, on long-term planning, and he's also hands-on within the company as well. He's been able to maintain strong relationship with regulators, investors, brokers, and all. Okay, so. I'm not too sure most of us know that this company is also a family-owned insurance company. Mutual Benefit was founded in 1995 by Dr. Akin Ogunbiyi. Dr. Akin Ogunbiyi still has, some significant influence on Mutual Benefit. And they began as a very small outfit, and today, this company is probably one of the first 5 life insurance companies in Nigeria. Just so you may know that this company doesn't do annuity. So if you strip out annuity from all other life insurance company, they'll probably be between first 3, and what have they done? They've actually grew their retail space. They are also very involved in, group life as well. So they've diversified into micro insurance. I think they still have that, Mutual Benefit micro insurance company. At some point, it will look as if Mutual Benefit is the only insurance company in Nigeria because you see them, branding all BRT buses in Lagos. That was when they went into micro insurance. So, like I said, Dr. Akin Ogunbiyi still have, a very significant role in Mutual Benefit, and he's been the pillar behind this company. It's also one of the early adopters of microinsurance. So when microinsurance started, Mutual Benefit was also, a part of it, and they also target low-income earners. Okay, so I think those are classical examples of companies that have been able to identify as family-owned insurance companies. So what I wanted to do now is basically to look at some other insurance companies, that has been family-owned, but they've had some sort of setback, and and we also look at what actually caused those setback. The first one is Insure Group Manager, and this company is from South Africa. It was established in 1992 as Insurance Outsourcing Manager, and they later rebranded as IGL. So this company is not an insurance company, but they are like a premium collection, companies for insurance companies in South Africa. And at some point, they were managing about 15 billion rand premium, and they have about over 400 corporate clients, that they were managing. But what happened? These are the founders, two prominent people. Charles Cilliers is the founder and later CEO. Then Diane was actually the one responsible for the operations of, these companies. What happened? There was a lot of misappropriation of funds. So if we all recall that as a broker, as a broker, right, you can actually withhold insurance premium, for a period of time, pending when you pay to an insurance company. So there was a lot of misappropriation of funds with this company, and so there was no, oversight. At some point, there was also some form of regulatory intervention, and I will talk about regulatory intervention at some point. So in September 2018, the Financial Services Conduct Authority in South Africa, placed this company under voluntary curatorship after discovering a shortfall of about 200 million rands, in outstanding premium that is due to insurers. So as I time this company, went under, insurance companies in South Africa were being owed about 1.5 billion rand with about 660 million rand overdue. What are they miss is that there were a lot of issues, operational issues with these companies. They had the executive director didn't really manage the operations side of this company properly, and so there were a whole lot of issues around remitting premium back to insurance companies and all of that. Okay. Okay. So what are the lessons here? If you have an insurance company, there is need for an oversight. Sometimes we bring in employees, we bring in stakeholders into the companies, and if interests are not aligned, this is the type of thing that we get. So there need to be someone that will ensure that there is an oversight that is more robust and that are foolproof. And so that is the lesson that we need to learn. Also, the transparency and accountability issue is also something that we also need to take note of. Okay, so this is Lion of Africa. For those of us that have been around for a while, we know there is a Lion of Africa in Nigeria, right? But that Lion of Africa is not a family-owned business. This is actually a South African owned entity, and it was owned by the Black South Africans. They actually deals with short-term insurance businesses, and so this company was owned by Brimstone Investment Corporation, and this same Brimstone was founded by some Black South Africans, and so the owner of Brimstone Investment Corporation invested in Lion of Africa, and what causes their setback? These companies are making loss at some point. There were also some regulatory challenges, and maybe at this point I need to talk about these regulatory challenges because in as much as we are in financial services, and we need to be regulated, there are also situations where regulators need to sort of take some drastic decisions, especially when we are having early signs. Most of these companies, there were early signs, Regulators think that this move can turn the tide of these companies, but unfortunately, they couldn't. The company took a strategic decision to wind down in November 2018, and Bridgestone decided to voluntarily and systematically wind down Lion of Africa operations in South Africa. So like I said, these are some lessons that need to be learned in terms of adaptability. Our company must adapt to changing market conditions and regulatory environment to remain viable. In terms of financial sustainability, we also need to maintain profitability, which is very crucial. I mean, we are all in the business to make profit, and if the company is not making profit, we need to start reviewing our operations to ensure that company can sustain themselves in the long run. Okay. So this is a company called Resolution. Resolution was founded in 2002 by Peter, initially as Resolution Health, because they started with medical insurance. At some point, they rebranded in 2013, and the company was renamed Resolution Insurance as they expand into other areas of insurance across the East African market. Their business model was clear. They offer medical insurance with about 90% of their premium derived from medical policies. And what were the reasons for the setback? So if you look at the trend, all of them had some form of financial mismanagement, in their reasons for setback. There were accumulated liabilities, client fund about 6.5 billion Kenya shillings. They reported an underwriting loss of about 47 million in financial year 2021. After that, they failed to meet statutory requirements, which relate to capital adequacy, because you need to have some level of capital for you to, write insurance business in Kenya. And so they also couldn't submit their returns on time, and they also had some governance structure issues. So shareholders, couldn't also, pump in more money because the one that they've already put in, they are not getting returns for it. So what's the point of, bringing in more money when you know that, the one you have, you've not even gotten any return from it? So despite that, they had discussion with the Insurance Regulatory Authority in Kenya. And so in January 2024, the High Court appointed, Long Itra, who is a liquidator, as interim liquidator to oversee the winding up of the company. And so as we speak, this company has been wound up. Okay. So this is another insurance company. So this company, Standard Assurance, the major shareholder is Wilson, and the reason for setback is, is very funny. The director borrowed about 103, million shillings, from the company, which in itself is a violation of insurance regulation. Meanwhile, the limit for directors borrowing is about 20,000 shillings. So imagine 20,000 to about 103 million shillings. That's, quite huge. So Wilson also withdrew about 55 million for personal use, while the former general manager took about 9.9 million. So that's not all. That's not all. Company associated with Wilson, Prudential, there's also an hotel, they have some other, insurance entities. They received loan about 35 million from this company. Because they were unable to manage their corporate governance very well, brokers and agents also failed to pay premiums. So the question is, why are you now in business? So as at the time this investigation was done, about 396 million shillings, were being owned by brokers to these insurance companies. This one is even much more funny. Employee absconded with petty cash running to millions of shillings, upon realizing that there is, So the thing also is, all of this is due to poor corporate governance, because the corporate governance is not tight. That is why somebody could, abscond with millions of money when they know that the company already has a problem. So imagine all of this has happened. How do you now want the policyholder to cope? So there's also the part of our insurance regulator. They fail to detect and act upon this, in a timely manner. So as we are also blaming the insurance company, employees and all, we also need to put some blame on the insurance regulator. So in 2008, the insurance regulator appointed a liquidator to oversee the company operation, and so the company was declared insolvent with assets totaling 611 million as against a liability of 1.3 billion. Okay, so coming to Nigeria, we all know IGI. IGI used to be, a very prominent insurance, used to and is prominent insurance company in Nigeria. This company was founded in 1992 by Dr. Remi Olowode of blessed memory. The family had significant influence in this company. Okay, so if you all know IGI in the early 90s, they are the sponsor of the Super Eagles, during the early 90s. They do, sponsors, sports, mainly. And the reason is because, they are very big on government accounts. What happened? There was rapid expansion of these companies at some point. There was also post-succession planning, arguably so, because of the influence of the owner. They had liquidity and solvency issues due to uncollected premiums and large liabilities. So what lessons should we learn here? Succession planning is very, very important. We can relate with the example of Leadway, where we've transited from father to senior brother to junior brother and all. So if you have a company and you're unable to plan your succession, you are also saying that this company should, there's also always a doomsday for this type of company, and the growth must be matched with adequate capital. So why this company was growing? Because they had very large account, government account and all. In terms of capital, to match this growing enterprise, they didn't have it. They have a lot of properties, that are more fixed, they have properties, as asset, but those properties are not liquid enough, to actually service, their client. And so, at some point, this company was, just there. But I can tell you that this company is back. They are on their feet, and we pray that they will roar again, right? Okay. So, GNI, this company is still operating. We all know GNI, right? So GNI used to be a company that was established by the Western Region government. At some point, there was some prominent person, and that's why I bought this company. This company was established by Western Region government. A key figure was Talabi Braithwaite. We all know the doing of insurance, right? We all know the Braithwaite family, that they are very prominent as far as insurance is concerned in Nigeria. Yeah, they established this company. And at some point, there was some internal mismanagement and leadership conflict. There was also lack of modernization, in the company at some point. Ownership has changed and right now, and the company, has been restructured. I think they've been restructured like 2 or 3 times. They've also done some, rebranding at some point as well. Family business must evolve with industry changes. So we need to move with the tide. You can't say that you've established a company and then you want it to grow without you looking at your environment, to see what exactly is happening there. There was also some internal dispute at some point, and failure to modernize also affected this company at some point. Okay, so I think that is that. We'll briefly just go into lessons, and these lessons are basically almost everything I've spoken about. The first one is for actuaries, in terms of governance, what is our role? We need to maintain professional independence because we are also in this company as a stakeholder. We need to sort of, be able to, withstand the pressure that will come to us. And so we need to engage directly. If we are not doing that as an actuary in your office, you need to engage directly with the board, and try and escalate any misgovernance that you see. In terms of capital management, we also need to ensure that, capital is adequate, and you also need to be sure that your reserving is prudent. Don't. Okay. So we all know what I'm talking about. I mean, there will always be pressure as far as reserving is concerned, right? Okay, so in terms of involvement, we need to go beyond pricing into growth and investment oversight. Actuaries are now doing the extraordinary. We've gone beyond just being a pricing person or a reserving person into even participating in, strategic discussion, operations, and all of those, And then we also need to institutionalize system beyond, the founder's dependency. So let us look at the end in sight, And in terms of ethics, I mean, that is within, our control. And that is what the professionalism always preaches for us. We also need to drive product innovation and excellence. Okay, so quickly to move into sustainability. I mean, these are all what I've spoken about in terms of governance, capital adequacy and prudent. Succession planning is very key. Regulatory compliance is also very key. And then in terms of risk culture, we also need to imbibe the culture that is right for our organization. And lastly, for adaptation, we need to, start thinking about, if we have not started at all, we need to start thinking about digital transformation, agility in product designs. We also need to ensure that our organization continue to be a lean organization as well as, response to crisis at any point in time. I think that's, okay, just one more. So for competitiveness, and this is where, we also need to, be more professionalism about what we do. I mean, we have to, wear that bigger picture outlook. We also need to participate in building trust within our organization as well as ensure that when diversification is about to happen, we are also, we need to be part of that as well. I think that is that. Thank you very much.
Thank you so much. I just want to see if anybody's got any questions for Ganu.
Questions, anyone? Let me say it in open. Anybody get question? Okay, comments.
Well, thank you for your lecture. I just want to mention that in all the issues of family business and sustainability, one thing is clear. In all those companies that had setbacks, there seems to be leadership deficit or trust deficit in their business model. And two, the cases of Leadway and Custodian. We've done one or two researches on these two companies, and we discovered that these companies took investment seriously right from the onset, and didn't focus only on underwriting and claims management as most insurance companies do. They were very key, like Leadway. They bought 20% of Prestige Assurance, bought 20% of First Bank, and they had a very strong actuarial department and investment department. So these are issues that face us in the system for now, and actuaries should get involved in these two areas very fast, for at least even for us to have the actuarial visibility we're talking about in Nigeria.
Thank you. I think it's spot on. So like I said, for Leadway, they've actually invested far and wide. Same for Custodian as well. Like I said, they've gone into banking, hospitality business. They are also in HMO, pensions and all of that. So that's very key. For you to succeed as an insurance company, you also need to, look at that investment part as well. We know that, insurance companies need to, sort of on their skill in terms of underwriting, but I mean, underwriting profit is not enough. We also need to sort of, look at what comes into the bottom line. No, it's not.
Thank you very much. Can we show our sign of appreciation, please? Oh.
Oh, sorry, I had a question.
Yeah, okay.
Thanks, Ganyu, for your presentation. So my first question was, what is your definition of family-owned business? Is this like a company that has private shareholders who's not listed, for example, or do you mean like a family controls the stake and has like people in the company who are relatives? Like, I just wanted to understand that sort of in terms of your analysis first.
Okay, so what I've looked at are basically companies that are owned by people, family. Most of them are actually, transited from being a private company to a publicly listed company. Some are still privately owned. But aside that, I also looked at, companies that have a very strong person, individual within the organization that are sort of, controlling the direction of such an organization. So you see some companies that have some prominent names, behind them. And so those are companies that I've looked at. Thanks.
No, so that's really good. It makes sense. But I think a lot of the examples you gave are really impactful, and obviously, okay, all I wanted to say is that there are successful, should I say, family-owned businesses, and like if you think about a Leadway, so they have a strong person, but they also have like a Swiss Re who's an investor, and I guess most of the companies in Africa, start that way. So I guess in a lot of ways, I know you work for AXA, which is a different entity. But if I look at Kenya, for example, even the large insurers, like your Britam, your ICA Lion, you would call them family-owned or started, especially like ICA Lion, because it's two brothers.
Some are not family-owned, but I was just trying to bring out that prominent person.
Okay. So more about key man risk type. More about like key man risk or in an entity. No, I think thanks for your presentation.
Okay, thank you. Cool. So we're moving on to session 4 of today, which is creating value and building resilience. Please can I welcome Abudan Oganiki, who's a partner of EY.
Abiodun Ogunoike. A round of applause, please.
Thank
I'm with you, don't worry. I'm with you.
Apologies. Abiodun is a partner with EY and leads the financial services risk management for EY West Africa. He has 17 years of experience as a risk consultant and as a one-time deputy chief risk officer for a Nigerian bank. In his role, he provides governance, risk management and compliance services to over 50 entities in Africa, including multilateral banks. He is a CFA chart holder, a certified financial risk manager, a certified internal auditor, and a certified fraud risk manager. He has contributed to several thought leadership materials at EY on governance, risk management, and compliance management. Thank you very much.
Thank you, sir.
So good afternoon, everyone, and thank you, the leadership of NAS, for having me here today. I will be talking briefly on creating value and building resilience in an evolving economy. You will all agree with me that we are in a rapidly evolving economy, and just like the last presenter, Ganil, made the presentation, every company needs to understand the terrain and be able to adapt or transition and thrive, otherwise they might fade off over a period of time. So the purpose of my presentation today is to really look at some of the things we can do or we can learn from certain organizations to make them thrive over different periods. So I also want to probably put a question in our hearts before we start, or in our mind before we start. What does value creation mean to you? And what does building resilience mean to you? What does it mean to you? So yep. All right, okay. So the presentation will focus on the few key points. I will look at key drivers of value creation in today's fast-changing economy landscape. I will look at core challenges facing businesses in an evolving global economy. I will look at actionable strategies for building resilience. And we're also going to look at insights from real-world case studies of resilient organizations. So we meet today. I have he's one of my colleagues sitting at the back. He's a consultant at Ernst & Young as well. And yes, I've talked about myself earlier on. So moving straight, so what does value creation mean? So creating value involves producing goods, services, or innovations that meet customer needs and generate long-term profitability. From this definition, I would like to focus on two key things. Number one, customer needs. In creating value, we need to be conscious of what our customer needs. And then secondly, we also need to be able to look into consideration profitability, especially sustainable profits. And I think Gani also talked about that when he was talking about profitability. It's important for us to look at sustainable profitability, otherwise it's just a matter of time. So Apple, for example, as a company, has mastered value creation by focusing on a user-centric design and creating an ecosystem that integrates hardware, software, and services. Yes, you ask me that we largely work with insurance companies. Yes, that's true. But the point that we're trying to make here also is that where are the points of value addition in your entity? And as we go to the next few slides, I will be touching more on those key areas. All right, so when we look at key drivers of value creation in today's fast-changing world, several things come to mind. I mean, it's a period when we've had several geopolitical changes, technology shift to economic uncertainty. But I would like to focus on 6 key factors, the first being customer-centric innovation. Innovation is a key word here, because as we understand the needs of our customer, it's also important for us to innovate products that will meet our customers' needs. And just to quickly talk about this, I work with a lot of banks, like I said, like my introduction mentioned. And there is what we do similar to OSA called ICAP for banks. And while I was discussing with the leadership of a bank, the issue of cyber risk came up. And the question was, do we have insurance companies that can help underwrite cyber risk for banks? So that's one of the conversations. The second conversation, also performing some ERM services for some oil and gas company. Then the question arose, can we have insurance company that can also insure ESG risk? I mean, the question for you as an actuary or a risk manager is, if we are going to underwrite this kind of risk, what is the capital and how do we effectively price this? Or like you said in the prior words, how do you make enough reserve even for those kind of transactions? So I mean, I'm saying this upfront because those are some of the key points or pain points in some of those industries, and these are some of your customers. So creating products and services that solve real customer problems based on deep understanding of customer needs is one of the key considerations for value creation in today's fast-changing world. Procter & Gamble uses ethnographic research to develop customer products that resonate globally. The second factor is operational efficiency and streamlining back-office processes, reducing manual paperwork, and cutting turnaround time in areas like claims processing, premium collection, or pension payments are certain areas we also need to look into. And we have Nigerian insurance firms that are adopting mobile-based claims tracking, and pension fund administrators also adopting e-platforms to update beneficiary records. And this helps to reduce the delays, the errors, and overhead costs as well. The third factor is digital transformation and technology integration. You hardly go to a conference today without discussion on AI, because AI has come to stay. Yes, there are different views, but the truth is everybody needs to evolve. Everybody needs to embed or integrate technology. So using digital tools and technology such as AI helps to improve business processes and create new revenue opportunities. You remember my word at the beginning, sustainable returns. So fintechs and insurers are leveraging WhatsApp bots, USSD codes, and mobile apps for onboarding, policy management, and real-time risk tracking. Also for bank, we have this bank ecosystem where we have what AI can do in different departments within the bank. So it's important for us to also think to evolve on how AI can also help you to do your work better. Talent and organization culture is also very important, particularly in some parts of the world like Nigeria, where we have a lot of japa and all that. Thankfully, that has reduced a bit. But if you look at it 2-3 years, you will discover that almost every institution in Nigeria lost almost all their team. I mean, we also as consulting firms, we are not immune. My team, if you look at the current team and the team 4 years ago, personally my team, probably you have maybe 4 or 5 people that have been consistent over the past 4 years. And then it's a team of about over 50 currently. So you can see, the transition or the attrition, as the case may be. So there's a need to build a skilled, adaptable workforce and a culture of innovation, accountability, and continuous improvement that also helps to drive value creation. Flutterwave, one of the Nigerian's leading fintechs, invests heavily in engineering talents, cross-functional collaboration, and a startup culture that encourages fast testing and learning as well. Fifth point is strategic partnerships and ecosystem. You need to be able to also collaborate and identify other stakeholders that could also support you in getting sustainable returns. So collaborating with other organizations to access new market technologies or capabilities. You see Apple App Store also creating an ecosystem with massive value addition by enabling the developers to innovate within its platform, and also that which benefits all parties as well. And lastly is the brand equity and customer trust, where you also build a trusted brand that commands premium pricing and customer loyalty. So by knowing your customer, you'll be able to know those who are also particular about the loyalty, those who want to stay with you for years. So building your brand and also customer trust is also very key. When we talk about Tesla today, what comes to mind? So you see that Tesla has created a brand associated with innovation and sustainability, allowing it to dominate the electric vehicle market and attract investment. So moving on, what are the challenges in today's evolving economy? Number one, we have the economic instability. Fluctuation in interest rates, inflation, supply chain disruptions, geopolitical conflicts, and of course, potential signs of war and all that. All this creates unpredictable market conditions, volatility in the crude oil price, and several other volatilities in the economy. So this leads to difficulties in long-term planning, budgeting, and investment. Number two, technological disruptions. Rapid advancements in AI, automation, and digital platforms are reshaping industries. The legacy systems become obsolete, constant pressure to innovate and retrain talent. The third point, changing consumer expectations. Consumers demand personalized digital-first experiences and sustainable practices. Companies must also adapt quickly or risk losing relevance. Number four, talent shortages and workforce transformation. A growing skills gap, remote work culture, and employee expectation for flexibility and purpose. So this leads to difficulty in attracting and retaining top talent and the need for continuous reskilling. The fifth point is regulatory and compliance pressure, increasing global and local regulations around data privacy, ESG, taxation, and trade. And this leads to higher compliance costs and operational complexity, especially for multinational companies or institutions. Global competitions and market saturations. Businesses now compete globally due to digital access and open markets. So we can no longer say that this is a Nigerian market, is only 5 of us playing in this place. No. The market is open, there is global competition. And the impacts that Nigerian firms must sharpen their competitive edge, or wherever country you are, you must sharpen your competitive edge and focus on product differentiation and operate with greater agility to stay relevant. So I'm going to move a bit faster for the sake of time. So strategies for building resilience, number 1 is diversification of revenue. And it's explanatory in itself. So you need to reduce on single markets, single products, single supplier. You need to be able to expand, expanding beyond life general insurance into micro. And I think the speaker talked about that. Micro insurance, health tech, pension-based mortgages, agency network, any area that helps you to be able to enhance your revenue generation, it's very key. The second is agile operations and decision making. You also have to be agile. Agility is a key word here. Then you need to invest in digital and data capabilities. Of course, strong organizational culture and leadership also is very essential. So I'm going to move a bit fast, but I'm going to touch on key points. So on an annual basis, EY collaborates with the Institute of International Finance to run a global survey with CROs. So we have comments from different CROs across the world. And when we look at the top 10 CRO priorities in 2024, the number 1 risk is cyber security risk. So I ask a question as an insurer. Are you on the right in this risk? Are you preparing yourself for this risk? And how are you playing in this? Because we are talking about a changing environment. Operational resilience is the second risk. Number 2 top risk. And number 3 is the geopolitical risk. I'll move on to the perspective of the board. The first one is the top 10 by CROs. The next is the top 10 by the board members. Similar to the CROs, number 1 risk is cybersecurity risk. The second is geopolitical risk, which was the CROs number 3. Then the third, implementation of regulatory rules and supervision, is the third for the board members. Now, what are the top skill sets that risk management resources should prioritize? In this fast-changing world, there is a need to prioritize digital acumen, technology, data, generative AI, programming. And this is the feedback from the CROs, that this is one of the keys. 63% feels that digital acumen is number 1. Ability to adapt to a changing risk environment, 54% of the CRO chose that. 51% says deeper specialization in at least one domain. Then, most significant ways of using machine learning and artificial intelligence. I mean, as AI is becoming topical, so the question is, what do we typically use this AI for? And the comment from the survey, number 1, AI is being used more increasingly for data analysis, including anomaly detection. Secondly, automation of operational tasks, routine tasks. And number 3, automated analysis of documents, e.g. the optical character recognition, natural learning processing. Was yesterday that a client called me and said, we want a GRC tool. I want the GRC tool to be able to help me rate different investments. And I want to just give the tool the financial statement of that company that is issuing the instrument, and then give me analysis, should I invest or not? Every other thing programmed into the application. So it just shows that these are some of the ways that the CROs are already thinking about adopting AI. So what are the most important skills required over the next 3 years? Again, this is survey response. You have cybersecurity skills, AI-based model risk management, use of machine learning and AI. So we have been doing well, but we also have to start thinking about the next level. So what are the evolving role of the CRO in the next 3 years? Develop and grow the next generation of risk leaders and deepen succession strengths in the second line. I mean, this is important for most of us, particularly if you have a lean team. So one of the key considerations now is who takes over from me? Who is my deputy? How strong is my deputy? What is the succession plan? And like the comment made on the table after the last presentation about key man risk, one of the reasons why we have the family business stay over the years is the management of the key man risk. If key man risk is not well managed, most family business will fade off over time. Second is to serve as an advisor to the business in preventing risk from materializing. And I think that also was echoed earlier today, that we should go beyond just computation, determine reserves and all that, to also being an advisor, being able to see risk. And risk is not just about negative side. What are the other positive things that you can also see that you can, latch on? Serve as a watchtower for triangulating and advising the board and senior management on intersecting risk. Again, this is also talking about an advisory role and a strategic role as opposed to the usual one we are used to. So moving on, what are the skill sets with the biggest challenge attracting the talent? Where do you struggle with from CROs? Where do you struggle to have resources? Cybersecurity, AI-based, and use of ML. So I'll move on to the next, which is also a similar survey that was done to the board in the EMEA region, Europe, Middle East, India, and Africa. And again, it's trying to get what is the board focusing on in the next 1 year. This is for 2025. And what the board mentioned is geopolitical volatility and resilience, shaping tomorrow's workforce. You see, workforce is coming in again. Technology, digital transformation, and cybersecurity. Sustainability, integration. And for us in insurance companies, sustainability is really growing. So for the companies you are insuring, how do they embed sustainability even in their business? Then, of course, navigating compliance challenges and regulatory demands, and then broad priorities in 2030, looking ahead into the next 5 years. So you can see that some of these comments are also similar to what we've gotten before, which shows that these are the key areas, even in an evolving economy. So I will start to wrap up now by dropping certain more key strategies we could look into. So innovation and continuous learning is also something we have to embrace. We have to continue to develop ourselves. Data-driven decisions, very, very important. It's good to embed different ratios, different leading practice. What do we use with those results? How does data help us to be able to make informed decisions? How does data help us to transform our different companies or insurance companies or institutions? Customer focus, I've talked a lot about this. We need to understand our customer. We need to understand that the market is no longer a Nigerian market or a Lagos market, but a global market. Your current customer can be poached by a company out of this country. So you need to continuously understand what your client wants or your customers want. You need to continually innovate and try to position yourself in a way to attract them. And as I'm talking about this, I'm talking to myself too. Ernst & Young, our end of the year is June. So by next week, we are starting afresh from ground zero. So we also have to go through that strategy session. What are we going to do differently in the next financial year? We all have to keep, thinking through the next step. Strategic partnerships, very important. How can we leverage, instead of you doing it afresh, how can you leverage those who are doing it before to be able to get traction? I know one of the discussion earlier on also was how Leadway also acquired the life insurance transaction of certain institutions. It's also to gain traction. Instead of you doing it afresh, who can you partner with that can also help you to gain traction? So 2 more slides, then I'm done. All right. So, in talking about embracing technology for change, where do we see that, applying? Number one, automation and artificial intelligence adoption. So we also always need to keep looking at how do we embed AI in what we do, and it can be as simple as even presentations like this. Before you go to a presentation, what are the key things you should focus on for completeness? And even what are your clients? So when I talk to my team members, I will ask them a question: what is AI saying, or what is the outcome of AI on this area you are working on? Yes, you are a master in this area. You've done it severally, but you could be missing out certain other things. And I give a practical example. When I was talking to a client about credit rating, I've always done credit rating for several years of my life. I mean, I started my career with KPMG, a decade there and all that. But I have to still go to AI. What is new about credit rating? And the perspective of presenting certain information was different from what I always used to know, which is really where the continuous learning also comes in. Digital transformation also is very key. Data analysis is very key. Customer engagement through technology also is very key. Most of your customers today are going for more automated or digital friendly customers than just providers or vendors than just the manual vendors. So some of the case studies quickly. Flutterwave, I'll just quickly touch on one point. The ability of Flutterwave to swiftly adapt during crisis, like facilitating digital transactions amid COVID-19 pandemic, illustrates the importance of agility and customer-centric innovation. Then we go to InterSwitch 2. By expanding its core switching services to a broad portfolio of digital financial products, including the highly successful QuickTeller platform, InterSwitch has diversified its revenue streams. We are risk managers, but we also have an advisory role to impress or to discuss with the board. So we always also need to look at how we can improve. And my last slide before I go, recommendations to actuaries in a changing world. Actuaries must navigate through uncertainty. From risk managers, you need to transit to value creators. Look beyond the balance sheets, integrate ESG factors, leverage AI and big data. Unlock new opportunities. Resilience is the capacity to adapt and emerge stronger. Design insurance products for climate adaptation. Create financial models for systemic risk. And like I mentioned earlier on, customers or your clients are looking for insurance companies to underwrite ESG risk and cyber risk. It also doesn't mean that you should just go ahead and start. You need to also ensure that you also have processes, controls in place, and then you price well such that you also don't get bonds. Because you might also want to move with the trend and get bonds, but it's just for you to have proper plans, but focus on the key ask of your customers. And finally, help organizations thrive through shocks. So as you are thriving, you can also help organizations, because that's really what your business is. So embrace collaboration across disciplines, commit to lifelong learning, invest in own growth, and continue to be trusted advisors. Thank you so much.
Thank you. Does anybody have any questions?
Thank you. Yes, thank you very much for your presentations. You have given us the challenges in the evolving economy, especially our economy in Nigeria. But you did not mention the risk management. I mean, the inadequate risk management that we have, especially in the insurance industry. We know in the insurance industry, just like the last presenter, there are a lot of fraud, and it's part of the risk that actuaries should not neglect. Actuaries, as they assess and assist in managing risks in the insurance industry, they should remember that there are risks of fraud, management fraud, occupational fraud, and so many other frauds that we know they are in the insurance industry. And those types of frauds affect resilience. A company wants to move forward, but fraud usually frustrates, especially for us here in Nigeria. So I feel we should, in managing risks, we should do it holistically. All potential risks should be anticipated, and provision for managing it well should also be put in place. Thank you.
Thank you so much, sir. So there are several risks that is peculiar to us in this environment, and beyond the operational risk also is a compliance risk as well, which is the KYC issues. By FATF, Nigeria is one of the countries in the grey list, and what that shows also is that we are also a country that is open to financial crime as well. So yes, those risks actually abide in different companies in Nigeria. Thank you for adding that to the discussion.
We'd just like to present you with a gift. Thank you very much for presenting today. And can we show our appreciation? Thank you.
Thank you so much.
And
Thank you so much, sir.
And can we also recognise Mr. Garner, who spoke earlier as well, with a gift? Thank you. Thank you.
Thank you so much, sir.
Fantastic. So we have lunch break now. We've got exactly 1 hour. We're going to put the QR codes on here, so if people want to be able to use the QR codes for the different speakers, they can do that, but it will be up here. Lunch is going to be in a different place today because we've had heavy rain, which is a good thing. We're going to have lunch inside. So sorry? Naz. So there's a QR code for NAS feedback as well. Well, it'll be an hour. We've got an hour for lunch. Okay. So it is 12:35 now, so if we could start at 1:35.
And as she noted, we'll be having the lunch indoor now, since the weather outside is messed up. So we'll be having it not.
It's in the restaurant. It's in the restaurant lobby, I've been told.
All right.
Yeah. Okay. Thank you. Thank you.
Kind of nice to have my CAS in the background.
This one, right?
Yes.
one person. I would have to go and check with the person, but it's only one person essentially.
I cannot miss this.
Yeah.
I will not miss this. As you come, say my phone. No, let me snap. Let me snap first. No. I will upload this video. Don't worry.
Because I mean the units consumed are almost like
Okay,
so they're going to just
okay, are they jealous?
you're coming too. But I mean I'm just because the meter reading is above what it is with that meter reading, it will mean that the meter is moved. So unless something is happening that is clear things there, but anyway, I'm feeling
This woman, good one. She gave me an assignment now. What to kill out those? Okay, look at that glass. She won't give me. So, how can I not be grateful? I said, as they are calling.
So you started to use the heater more and the flames when you started. double check because I thought it was saying about when you move in the so I'll check. Yeah, I think so. I think so. Yeah, okay. Alright, let me. Okay. Alright. Alright, thank you. Alright, good. Alright, thank you very much. Bye.
Welcome back, people. Please let's get back and settle down so we can kick off from where we stopped. Please, as we get back in, let's settle down. It's almost time for the next speaker. Please, let's settle down. Come inside. Let's continue from where we stopped. Please come inside. If you can hear me from outside, please let's continue the show inside. Please, let's come back inside. Let's come inside. The event is built to continue any moment from now. Please come inside, settle down, and let's continue the show. Welcome back. Welcome. Welcome, welcome, welcome. Welcome back. Please let's settle down. If you missed any of the lectures from the previous day, you can scan any of the QR codes to catch up for the feedback here. To give feedbacks, you can scan any of the QR codes. You're welcome, you're welcome. Our next speaker is set, so we're waiting for everyone to get back in the hall, and then we continue from where we stopped. To catch up with all of the old lectures, you can scan these QR codes and give back feedback. Please let's settle down. Welcome back, welcome back. We'll continue any moment from now. Thank you for staying with us since morning. We appreciate your presence here. If you're closer to the door, please help us ask people outside to keep coming inside, I beg, so we can take this off. Anybody outside, you're the reason we've not continued. Please come inside and settle down. We are back and live.
Welcome, everybody. I hope you all managed to have a good lunch. We're going to start session 5, ERM and the creation of a ORSA. And I must confess, I don't know what that is, but we'll hear it very shortly. The speaker is Steve Bedlin. He's a member board of directors of CAS. Steve Bedlin is the chief actuary for North Star Mutual Insurance Company. He has served as a chief actuary for various insurance companies or divisions of insurance companies over the past 25 years. And he was elected to the CAS board of directors in 2022 and served as volunteer chair of the CAS Finance Council. He's also a member of the CAS Risk Management Committee, the RMC. Steve has served as an actuary in many roles since joining the insurance industry in 1977, receiving a Fellow of the Casualty of Actuarial Society, the FCAS, in 1983. He's also Certified Enterprise Risk Analyst, Certified Property Casualty Underwriter, and a member of the American Academy of Actuaries. Welcome, Steve. Thank you very much.
Ladies and gentlemen, a round of applause, please.
Okay, I've got a clicker here too. This is great. And I get this coveted spot right after lunch. So I guess risk management would say the risk is that you guys fall asleep. So I'm going to be careful about not letting that happen. My background is that I've been an actuary for a long time, and I've been working in the ERM and the ERM space for probably about 20 years, and ORSA for the last probably about 10 years not having to actually put in an ORSA until about 3 years ago, but went through that process of creating an ORSA in the US, which basically has principles and has a structure for the ORSA, and probably your ORSA is something different from that, but the basic principles are the same. And so I'm going to go through, it's general insurance focused. I'm from the CAS. We only do general insurance. And so another caveat here is that I work for a company that has a risk with severe convective storm. And so I asked the people I know around here if that would be interesting. They said, no, you don't have it here. But flood is the issue that you've got here. So I'm going to talk about flood kind of in the same way that I would be talking about severe convective storm as it pertains to ORSA. So I'll start with ERM. And by the way, thank you very much for inviting me here as part of the CAS. And also, thank you very much for arranging this so that you had so many good people talking before me that have covered aspects of what I'm talking about here. And I feel like you're all shills. Thank you. I appreciate it. Okay. So, my topic is ERM and the making of an ORSA, a general insurance perspective. So let's get the clicker to work here. That didn't do anything. Oh, I've got to go the right direction, otherwise it doesn't do much. Okay, today's talk. We're going to talk about enterprise risk management framework. It's not just an exercise. It's intended to, hopefully you're already prepared for the anticipated unlikely events, but at least to check out to make sure that you are, and to mitigate extreme consequences or give yourself the knowledge that will allow you to go in directions that will mitigate, to strengthen internal controls. All of those are things that are kind of the objectives of ERM. It's got to be integrated into company management. And there are certain tools you can use. Reinsurance, if you're placing reinsurance, that's probably an enterprise risk or it's associated with one. So your reinsurers are probably looking at you. And for us, reinsurers are really helpful in the whole thing. And there are a lot of mitigations that we'd want to think about. We're going to talk about our own risk and solvency assessment, the ORSA. And that's what it stands for. It's there on the second slide. And I'll do an example at the end, a deep dive into the flood risk, or not really overall the flood risk, but how you would go about determining what to put into a model as it relates to the flood risk. So what kind of information would you get? How would you put it together? What context would you put it in within there? So it's... I'm not an expert in flood. I have talked to people that are experts in flood, and not just ones that were in floods. So, now, oh good, I went the right direction. So the ERM framework, risk culture and governance is the first thing I'm going to talk about, and the idea of having clearly defined roles, responsibilities, and accountabilities. Risk identification and prioritization will be next, and ensure that it's appropriate and functioning at all levels. And then creating a risk register from that. Once you've identified the risks, let's keep track of what you got and have a structure for that. Risk appetite, tolerances and limits. And then that's a formal statement from the board. Risk management and controls, and risk reporting and communication. And all of those, when you look at the definition that the NAIC gives us for what's supposed to be in an ORSA, the biggest part of what you put into an ORSA is ERM, is your practices as a company for ERM. And every company is different, so you want to structure an ERM process that captures what your mission is and what types of things will keep you from attaining that mission. So it's very, very different. And so I'm giving you some suggestions, and more so, I want you to think about the framework for that. How do you make it happen, and so that it's yours? No. Okay. There we go. You not only have to hit the right button, but you have to hit it in the right direction. Risk culture and governance. Well, risk culture starts from the top and goes down. You know, you've got to have the management creating that culture and living that culture. And basically what that means is they need to recognize what their risks are. They need to want to quantify that, and the enterprise risks in particular. So I'm not talking about the little ones, just talking about those that could affect the enterprise. And to make that something that the whole company knows about, lives with, and et cetera. So the board and senior management own the process. Clearly defined roles are what we want. They own the process. They empower a chief risk officer with a role to coordinate and manage. And so the CRO ends up with the job of creating and documenting everything that we come up with. Coordinating mostly, I guess creating is also the part of the participants. So the other is that you want the risk culture throughout the company, not just an exercise, but a way of operating. And I said that earlier, but it's worth repeating. It's involving many functional areas and helps reinforce that culture. So there, flip the other way. Did it go? Yes. So risk identification and prioritization, that's that next thing I said I'd talk about. Again, they're not for everyday risks. Don't get caught up in the little stuff, because I know that when I started talking about being the chief risk officer, I started hearing about, you know, one company that did something, and I said, no, we want the big stuff. It's a risk of impairing the ability to achieve the company's mission. So it does mean that you have to know what your company's mission is, and sometimes they're very well stated, sometimes they aren't, and so sometimes you have to work on that piece as well. Board and senior management own these risks, and they need to be a part of the ERM process, and they need to own the ERM process, which means you can make it something that, you need to make it something that they understand so that they can own it. So when you're thinking about getting really complicated with it, if you can't explain it to the people that own it, then it's not going to do you much good. So remember who your audience is. Make sure that senior management certainly knows not all the technical stuff, but knows what went into the process, knows what that tells them about their business, because this is really telling them about their business. It's not about having a really refined model. Oh, that may be something that you do have. And then cover all aspects of risk. The strategic risk, operational risk, financial risk, external risks, those are ones that we classify in. There may be others that you classify there as risks. And I said, create a risk register and, you know, categorize it, give it enough information so that you know what these things are and can get back to them. Because you should need to be updating them all the time. So, what are ways of risk identification, strategies for risk identification? Well, one of the things we did was interview senior management and key managers and board members. And so what's the situation on the risks that we have identified? And by the way, we've been doing this for a few years. So we have risks that we've identified, and we've given it a grade in terms of how severe it is, how likely it is, and other things. And so we look that over every year. But you know, if you're going through the initial, you know, it's something that you want to do. Then review the company history and find prior vulnerabilities. Could they resurface? Are there follow-ons that maybe didn't happen in the prior history, but things that could have happened in that prior history if things were just a little bit more severe, or if there were other things going on at the time? And then I put in review industry failures and downturns for prior vulnerabilities. And you know, we just had a presentation that had a whole list of companies that had downturns, had setbacks. And so maybe get that presentation and take a look at that and say, could this happen here? That type of thing would be worthwhile. What I didn't put in here is current news and events. And when I think of how we worked on cyber, we didn't necessarily see it in the nearby companies, but we heard about things in the industry that could really affect us. So the news is another source of identifying those risks. Okay. So strategic risks. Well, we classify the competitor risks as one of the strategic risks. Market segment risks. Is your market shrinking? Is it growing? What's happening there? Is somebody coming into the market? So what's going on there? Regulatory and political risks. And we have those, and more so in recent years than before, but I think that would be distribution risks. Are you in the right distribution area? Should you be in microinsurance and distributing through, or should you use the current process, use agents, use brokers? Are you in the right place, and are any of those vulnerable? Strategic plan and execution risks. What's in your strategic plan? Are you going to be able to execute? And if you execute, is that going to put you in good stead? So those are various risks that I would classify under strategic, although again, you could classify them in other ways. Operational risks. Well, personnel are important to getting everything done, so that certainly has to be a part of it. And that includes having enough people to do things. It includes having the right people in management positions. It includes training them well and other good things like that. It includes having actuaries when you need to work on those things. A little plug, sorry. Technology and execution. Technology changes, and if AI is something that is going to help you tremendously, and it's happening with your competitors, they may put you at a disadvantage. I don't think it does yet, but I think that's something that could come up. Underwriting. What are you underwriting, and what kind of adverse selection could you get? Claims. Can claims handle, the claims department handle what you've got? And so that's another personnel issue, but in our case, with severe convective storm, we have most years with not very many severe convective storms and not very severe, but some years we get so many claims in a short period of time, and we measure our reinsurance in 4-day groups there. So in 4 days, you can get something that overwhelms the company. And by the way, 3 years ago, we had a period like that set us back for a while. And so you have to have, in this case, in the case of the severe convective storm or other emergencies like that, you have to have other claims personnel on tap and have them trained in a way that they'll operate in a way that works with your company, and et cetera. Endorsements. If you're dependent on key partners or endorsements from them, then the problems there could be enterprise risks. Pricing adequacy. So there are a number of things that, as I look at these, many of these are ones that we have or we have noted, and they're things that should be considered. Financial risks. I'll flip my page again. Internal controls. Well, we saw a number of companies that had problems with internal controls, and so that certainly is something that could come up. Investment risks. We've had a number of downturns, and if you've got a large investment portfolio, that could be something to work on. Business partnerships. Insurance. Do you have enough insurance for that really big event? And if you do have enough insurance, reinsurance, I should say. That's right after that. If you have enough reinsurance, is that reinsurance going to be collectible, or are they going to be in the middle of something really big when that happens? And so you also have to take a look at the quality of your reinsurers and the relationship with the reinsurers, and be able to work with them. And also have arrangements so they pay in a timely manner so that you can settle the claims or have the money when you actually need it. There could be cash issues with that. And then the IBNR, that's basically grading the actuaries. We have some very long-tailed lines that you can get yourself in pretty deep on. And my example there is we had an issue, it was a long time ago now, with medical malpractice, where for decades the relationship between doctors and patients were very close, and people wouldn't sue. But then there was kind of a social shift, and we ended up with a lot of lawsuits that wouldn't have been lawsuits before, and companies had written policies that were triggered on when the surgery was done, when the care was given. And so we ended up with a situation where the companies didn't have enough money because they were getting claims 25 years later that were now in dollars for the time of the claim, and it caused a lot of companies to get out of the medical malpractice business, and some of them became insolvent because they had big risks that they didn't adequately reserve in their IBNR, and maybe had no way of knowing that that was going to happen, but that can be an issue that shows up. So that's another piece that you ought to be looking at. And there are a lot of companies that consider that to be a big risk. And then we have external risks. Yep. So that could be facilities and systems, damage due to buildings, loss of the buildings. And I'm going to talk about flood in a little bit. And if your building's in a flood zone, that could be an issue that hits you. And if your IT, your computers are in that area, that could seriously compromise what's going on. Legal, regulatory, compliance risks. Catastrophes, natural disasters, man-made risks, which include ransom, either data or people, terrorism. There are a number of things that are man-made risks that need to be considered. And I don't mean this to be just a list, but I want you to picture what these things could do and how they might manifest with your organization. Okay, I got to go the right direction here. So, yeah. Risk prioritization. Okay. So, you need to determine from all these risks that you just put down, which are your key risks, and which are the ones that really could take the company down. And you find that some of the things that you identified really all come together in one thing. We had the severe convective storm risk, but we also had a reinsurance risk, which would be triggered by a severe convective storm. And we had some other things that were out there that all work together. So you've got to determine, based on this, what those key risks are, the ones, the situations that could put you in that place, and estimate the likelihood of them, the severity of them, and really the immediacy too. How quickly do you have to pay? And do you have the ability to pay if you have to pay very quickly? You may have the reinsurance, but it may not get to you right away. Or if you have some ways of offsetting it, but they don't happen right away. So, and then both before and after the mitigation that you have in place or you're planning to put in place. And then select a manageable number of those key risks and focus on those, because this is intended to inform the company about what their key risks are and to actually look at how variations in and events could affect what goes on with the company. So you're talking to senior management, so you can't give them too many things. It's and you want to make it something that they understand. And yes, they can know the whole list, certainly, but they should know the impact and how you've modeled that impact when we get to that part. And you can't do that with too many things, or it ends up being just a kind of a mess. Develop appropriate measures of the risk. So it has to be based on consistent and reliable data, or as consistent and as reliable as you can get. Compiled regularly so you can measure the changes in the risk levels so that you can be monitoring what's going on. And they might need point to the need for additional mitigations. Risk appetite, tolerance, and limits. These are something that all companies have to put together. Yeah, I'm going the wrong way. So it's got to be a formal statement. It's got to be from the board. The board has to own it. Senior management has to work on it. These are all really board issues. may be specific to a division of your company. It may be a risk that's coming from a division of your company, but these are enterprise risks, so if it's something that's from a division of your company, it should be large enough that it affects the entire organization. One of the things they also tell us that it should be on the group basis, because if the group has an issue, it could cause problems to all the different parts of the company. So you have to establish a risk tolerance, and so basically that's a range of acceptable risk. And then risk limits, and those are limits beyond which you have to take some action. It's not just can you tolerate something, but when you hit this level, then that triggers, maybe it's reporting back to the board, maybe it's getting out of a segment of the business, maybe it's triggering some sort of loan from a party that's enabling, or that will help you through that. That's prearranged, by the way. So state those limits and then stick to them. You know, when that comes up, if there's an action that comes from that, then it has to be met. You have to, when you hit that, you have to meet it. And all defined in one formal, cohesive document, so that it lines it out so that you can actually act on it. So the other thing is take active steps to monitor and mitigate the risk with clearly defined responsibilities, not just the company will. It's who's going to be in charge of that and how's that going to work, and you may have to rework that. Proper authority to take the steps, and that's to control the risk or to do the mitigations that are need happening, and it's dependent on a good feedback mechanism. So communication, risk reporting and communication, develop a regular monitoring and reporting methodology, and we have dashboards that we put in place, and they're not sophisticated dashboards, but they put the various aspects of the risk, things that identify that the risk is more, or that it's reinsured, or that it has some other aspect of the risk. Figure out a way of showing it in it could be charts, it could be maps, it could be other things that really think about those things that could really get management to understand what you mean. And so that's, there are a lot of different ways to visualize it. Deliver it on a regular schedule, at least annually, and some elements may be measured more frequently. If you get monthly data, you could be measuring that monthly. If you get daily data, it could be daily as well. Communicate the key findings to the board, and immediately when the risk, you exceed the risk limits, and regularly on an agreed schedule, so when you exceed them, you have to break the regular schedule. And in a narrative form, as well as reports and dashboards. So the ORSA instructions actually list all these things that you need to do, and I put a little color behind them, but these are things that are part of a good ORSA. So integrating ERM into the company management, it's got to be both top-down and bottom-up. Top-down's got to know what the risks are and know what their tolerances are, but everybody in the company should know what your risk tolerance is, and should be aware, if they're aware of things, they should be aware that they should be reporting to somebody who can get that information to the top, or at least get it to somebody who's going to be evaluated to decide whether it should be or not be a top risk. And that may be somebody who's not very high up in the hierarchy, but they're seeing something. And so that's a very important one. Mitigation of the risk may mean changes in the business. It could be refining target markets. It could be changes in underwriting restrictions or requirements, changes in required deductibles or limits, changes in the market that you're approaching, could be changes in the way you approach the market. Reinsurance structures are often put together for the key risks, So when you're trying to identify the risks and you're identifying the mitigations, look at your reinsurance structure, because those are ones probably you've already identified as the key risks. And improved data capture often is necessary in order to get this working right. So in the ORSA instructions, there are 3 required sections, and I've talked about ERM, and others here have talked about ERM as well. So you have to document the ERM process and findings, and all aspects of the ERM framework, risk framework. Assessment of those risk exposures, well, I'll be talking about that. That's all the modeling that we've been doing, and others have different ways of doing that. Assessment of the risk capital and prospective solvency, which leads to a statement of the company's conclusion and reasoning on what their risk and solvency assessment is. And if the company is part of a group, the ORSA needs to consider the entire group. As I said, if there's something that goes wrong with the group, it often affects all the entities within the group, and so that's something that they require, even if the ORSA is not required of the group itself. If you're owned by a foreign company and they don't require it, you still need to know what the group is doing and their key risks. So the process of assessing the risk exposure often includes a model of the company calendar year results by line of business grouping. And anybody who does planning probably is already doing that. And if you're doing planning, then you have a lot of assumptions in those plans that are, if things go exactly according to plan, this is the way it's working. So that's a good place to start, because you're going to be looking at what these key risks do to that result. And so that's the reason I'm saying it's a key place to start is because if it's a plan that's well used, then everybody knows that plan. And you've got something that they can grab onto when you talk about what the deviations are. So be consistent with the company's 3 or 5 year planning process, whichever yours is. And it may be longer, who knows. Grouping can be any reasonable aggregation of the lines and segments of business, as long as it covers all of what you're going to see. And so we've switched around the aggregations. In our case, with severe convective storm, we have many lines of business that are affected by that. So we do something on the severe convective storm, and then we do something on everything else, the attritional part. So investment and inflation and investment returns are driven at least in part by overall inflation. So an economic scenario generator often has or should have a connection to inflation along with the cost of the goods, the cost of the services that are involved in any kind of repair, and a lot of other things all connected together. And when I've gone through that, I've always chosen to use an outside ESG because they're understood, because they're documented, and I'm not an expert in the economic scenarios, so I want to rely on experts, and I want to be able to communicate this, in this case to a regulator and also to the board, so they understand what my scenarios are and understand where that variation is coming from. And so it's important to have that connected. The key risks from underwriting are often subject to reinsurance, so the brokers, the reinsurers may be able to help because they may already be modeling your risk, and they're certainly charging you for the bigger events in that risk. And so we do rely very heavily on working with the reinsurers, and in this case the brokers, to get an idea of what the variation is. But we have a bunch of models out there, and when we look at the models, they don't look quite right. They are based on theory, they're based on the storms, they're based on the values, but they don't capture everything. So be careful when you use some of the models that are out there. Take a look at your own experience. Take a look at not the really large storms, because the large storms could happen, but those that are kind of middle large, the ones that you see fairly regularly, and do you have the same frequency of those middle large storms? And if it's different, then adjust your expectation in terms of number of storms based on the difference between what you actually experience and what the model says is happening. And I like to quote somebody, and I don't remember who it was, but all models are wrong, and some are useful. And so, it's a way of thinking that I get out of the model, and it gives me a really good framework for that thinking. But I'm at least adjusting for the reality of the history that we have compared to what the model says should be happening. And of course, we have to bring everything up to current levels for the history, but look at that variation and see if your models are really, truly going to give you an estimate that makes sense with your own portfolio. Non-insurance key risks can be handled with scenarios of hits to surplus. So if it were a cyber attack, or if it were a ransom, or if it were something else like that, where you really don't have a distribution of what that cost would be, of course, take a look at what data might be vulnerable and what those costs might be. But it's really difficult to put a big distribution around that and have that with any clear probability. So my way of dealing with that is to pick a number and a probability for that number, another number and a probability for that number. Take a look what's happened in the industry, see if it's something that's reasonable, but do the best you can in terms of testing it with specific scenarios. And simpler models enable better focus on the enterprise risks. It's at the risk that maybe there's something that you haven't included there that might be big, but really you should be looking at the biggest things and evaluating if something else ought to go into your ERM process and into your ORSA. So I had the option of doing a very refined model of the 5 years worth of data and creating a scenario or creating a result every year, or doing a DFA, basically taking the current plan, current budget, and varying it. And I took the simpler one, which was the DFA, because it's easier to communicate, connects better, and I don't end up spending my time worrying about the minutia. I spend my time worrying about the big things, which are the enterprise risks that are in here. So simple is good. So the assessment of the risk exposures continued. You need to have a standard of solidity and solvency. And we use the statutory accounting principles. Other companies use GAAP. Some follow the people who are rating agency type principles. You need to follow the accounting principles, or maybe you have multiple accounting principles that you're working on here to determine who's looking at you and what you'd consider impaired. And so I'm sure that you don't have exactly the same gap as we have, and so you'd have to be focused on Nigerian accounting principles, and more specifically your company's accounting principles. Models help the thought process about the impact of risks, and they're not right, but as I say, they can be useful. And so use the models as a way of coming up with a thought process, and then if there are things that could be worse, could be better, then put that into the way you characterize it when you're making your decisions on how you're going to express and how you're going to create your conclusions. So the statement of conclusions based on assessment of risks and assessment of exposures, you take the quality elements of the risk management combined with the quantitative. And basically what I mean by that is think about what your model has modeled and think about whether there are other things that you need to include in that. To maybe it's worse, maybe it's better. Get that qualitative stuff in there as well. Determine the financial resources that are needed to manage long-term. And then, again, group risk capital should be performed for ORSA, even if the group's not subject to ORSA. So how would that work with a risk that's flood? And deep dive probably fits with flood pretty well. But so it's the risk could be the risk of the flood reaching your company offices and operations. And it could impair your ability to service insureds and customers. It may also be the employees who are impacted. They can't get there, or they have issues that are caused by the flood itself. So it can manifest itself in many different ways. The risk of concentrations of insureds who are in a vulnerable area or vulnerable in a single event, that's really something that you should know about, and you should be looking at. Maybe it's models, maybe it's other ways of looking at it, but look at those concentrations. So there are financial consequences, and management of those concentrations is pretty important. It could also be the ability to get to the claimants that may be at risk, not enough claim staff. And so establish relationships with outside adjusters so that you have that claim staff when this comes to pass, if it does. Mitigations, they could be reinsurance, risk sharing. You probably all have that. And a possible impact on the cost structure and the availability of the reinsurance in the subsequent years, but it's important to have, and it's important to have. And then let's find a model. And I did talk to a flood expert in the States, and he was able to tell me that there are indeed flood models that cover Nigeria. So find a flood model. Cat risk was the one that I was looking at. And they'd have both hydrologic and hydraulic models of the floods. So how does it move, and where does the water go? How does the water actually move? They look at both the fluvial, which is the rivers overflowing, pluvial, which is the too much rain and an area gets saturated, and you have things happen that aren't even close to the river, but they happen in the low points. So it requires a location of the risks and their elevations and the values of those risks. So what are you going to be on the hook for if they get flooded, and the vulnerabilities. So that's something that I'm not sure if this model has that capability, but it would give you an idea of where it would be, and you need to know the values, and you need to have some assessment of what the damage would be if the flood goes up 2 inches, if it goes up a foot, if it goes up 5 feet. Engineered models, and I call this an engineered model because it's taking a look at how things flow and using an engineering approach. They're constantly being refined, so keep up to date. There are new things that they're seeing. There are floods that happen. There are changes in the topography, things that you ought to be up to date with. Estimates the curve of the amounts of flood damage and their likelihoods for your portfolio. When you look at what they say about how high the river gets, and you look at the footprint of your insureds, if you've got that detail available, then you're going to be able to take a look at what that 1 foot higher does in terms of damage, and you create a curve of what it looks like if it goes up 13 inches, 14 inches, all the way up into those tough places. And that is what you'd want to use in terms of the risk or the damage that's associated with these higher and higher floods. And so the models used to figure out how often it floods and how high it floods, and then you need to superimpose that with your portfolio and look at what that means in terms of the damage, what that means in terms of the cost and what you're on the hook for. And so it's valuable for the pricing risk as well, because if you're going to be writing long term, then you have to know these things happen, and you have to price for them and have a risk charge, because it's going to cost you more when these big ones happen. And it's also really important for the ORSA model. It's a really good way of evaluating what the risks are and working your way through that. So kind of the ER models for ORSA, they address the key enterprise risks, including flood. I'm focusing only on the inland flood in this presentation. The flood risk is informed by these models, and you get the curve of CATs and kind of an annual distribution, or at least historic distribution, from what you're going from where you're going to be able to come up with a kind of a distribution of those. Adjust it for company bias, as I said, and then bring in risk reinsurance and risk sharing mitigation, so you know what the cost will be to you, and that mitigation may not be available to you when the real flood happens. It may have limits that you realize later on they only give you so many hits in your reinsurance contract, or something else comes up. You also have sometimes an increase in the cost of repairing things when you have too many people that are injured at the same time. So you'd have to factor that into the overall cost as well. Look at the retention and limits, and need to assess the ability of the reinsurer to perform. And if it's a flood, then if you have a risk, there are probably a lot of other companies that have that same risk. And so it's going to be a bad event across the board for the reinsurer. So you'd have to evaluate that as well. So give you a little bit of reference. We have a CAT risk tools reference. Basically, you look up this particular one, and you can get to, in various countries, what risks are modeled and who they're modeled by. And there may be more that aren't on there, but these are ones that, it was a source where I got to, the earthquake model, the CAT risk, and the GEM model. So those are places that you can actually go that, at least this reference says that there are models that cover Nigeria in here, and they may be more refined in other countries, but they're there as a place to start and start looking. And then if you've got addresses of your various risks, then you probably need a mapping tool. And a mapping tool that has elevations, and has elevations that tell you whether you're higher or lower than stuff around you. So when you're in those pluvial floods, then are you the person in the neighborhood that's going to get flooded, or is everybody else going to get flooded and you're higher and they're not going to be hit by that? And that's another piece of it. So I had some help from an expert, and so I gave him credit on this, and that's what I wanted to cover. Questions?
A round of applause. Question, anyone?
We have a question back here.
Yeah, thank you for the presentation. I might say, when it comes to ERM, that it's the risk culture that's one of the most important. So what are some effective strategies that you found in your experience that can help for the risk culture of the company?
Well, risk culture needs to be top down. So I try to make the meetings with senior management and with the board meetings where I'm listening to them as well as telling them what we're seeing, and I'm focusing in a way so that they can get a full understanding of what I'm talking about and what I'm seeing, and have the ability to maybe test what I have to say against what their knowledge is, and to think about what's going on there. And so since it's got to start at the top, you've got to make it explainable. You've got to make it believable. You've got to make it something that they will trust so that they can give you feedback. And they may say, hey, you know, I've looked at that, and that particular model doesn't make any sense to me. And then, you know, you work with them and you find something that does make sense. So I think it starts at the top. You need to get the senior management involved and get them thinking about this. And if you do it right, then they not only think this is real, but they think about those consequences. And their job is to keep the company going. Their job is to keep the company on their mission. And so you're hitting them in the right spot. So that's number one. Number two is make it clear to them that this is something that should be seen all the way through the organization. So think about how this would manifest in a way that other people in the organization might see it. And try and get communication to them to say, okay, we've got this flood risk. Help me know whether, you know, we've got this list of policies. What can you tell me about these particular risks? And if they're in this particular area, well, how susceptible are they to the flood? And get them to be thinking about the flood risk in this particular case. And if it's another risk, then thinking about that risk and underwriting around it, but also communicate about it. Find ways of getting that information to us. And it may mean that we have to change our data capture to get more information. And it may mean that we have to overlay this with something that's an external, like the GIS is a good way of maybe getting a better idea of what those heights are and et cetera. And if you think you got something that's a real concern, then maybe you work on getting a more detailed version of that. And so those are the things that I think of when I think of that risk culture. That you got to live that risk culture, and you got to communicate that risk culture and make it real for those people who you want to be thinking about it and working on it. And the risks are different in different companies. So you may not have a flood risk at all, you may not insure that, but you've got another risk that you know about. And by the way, when we send this into the insurance departments, nobody else can look at them because they realize that by talking about or by advertising your weaknesses, as an insurance company, it's not really good for your sales if you're telling all your weaknesses. So it's one of those things where you know your risks, and I've shared something that's pretty wide knowledge across everybody who looks at our company, but I won't share some of the other things because it's supposed to be proprietary. So anyway, thank you.
Any other question, please?
No.
The last person that asks question will go with him.
Please.
Going once, going twice is open offer, your chance to leave the country. Any question? I said that's a risk. Take this one.
We'd like to present you with a gift to show our appreciation.
Please a round of applause for him.
Thank you. Thank you very much. Oh, sure. So our next session is a presentation by ADA, the African Actuarial Development Academy. We've got two speakers. I think they're going to invite somebody in addition as well onto the stage. We've got Yvonne Palm and Mukami Nujuru. Apologies if I've got the surname wrong. So I've looked on their LinkedIn. I'm going to give a very brief bio on both of them. But what's unusual about these two actuaries is they've both worked in 3 continents, which is incredibly unusual for qualified actuaries to have worked in 3 continents. So Yvonne qualified in the US, she's worked in the UK, and she's worked in Nigeria. And Mukami has worked in Australia, the UK, and in Africa, as in Kenya and Nigeria. So we welcome them both to come forward.
Please, a round of applause for both of them as they come forward. So, beautiful ladies, please put your hands together for them till they get here.
So a quick bio on both of them. Yvonne is an experienced, qualified actuary that has practiced on 3 continents, dealing with insurance and financial business from around the globe in both executive and non-executive director roles. She's currently the Chief Risk Officer, Director of Risk Management and Compliance for Africa Re, specialising in reserving, planning, process efficiency, risk governance and compliance. She is an international speaker and passionate to develop the actuarial profession and related skills on the African continent and other developing markets, building up thought leaders that can cultivate homegrown solutions to uniquely African developing market problems. And Makami, experienced senior actuary with a demonstrated history of working in the insurance industry, skilled in enterprise risk management, training, delivery, modelling, insurance strategy. She's currently an International Association of Consulting Actuaries board member. She's on council for the IFOA and a member of the IFOA Risk Management Board. And previous roles include Head of Actuarial Insurance at PwC Nigeria and Senior Actuarial roles in Kenya, the UK and Australia. Thank you.
Mukami Unjero, ladies and gentlemen.
Thank you. Thanks for the kind introduction, Laura. Really good to have you here, coming from the UK to help organize this conference, and thanks for your contributions. So good afternoon, everyone. It's a pleasure to be here with you today. I'm going to tell you a bit about ADA, which is the African Actuarial Development Academy. I won't try to say the French version. Although I'm doing French on Duolingo. So in a few months, I should be there. So what is ADA, as I've been asked severally, although I think now there should be enough knowledge about it. So it's an Africa-wide academy set up as a non-profit organization to develop the actuarial profession in Africa. So it's focused on both actuarial professionals and the pipeline, which is the students. And this is just an interesting point that we found as a need. It's built on 4 foundational pillars. We do operate virtually. It is modeled on the success of a similar concept called the Actuarial Academy of East Africa. And it's backed by international actuarial organizations, local African actuarial organizations, African insurance and reinsurance players, and also international development organizations. So we're really proud of this concept and of the work that we've done so far. Why ADA? I don't think I need to belabor this point, especially in Nigeria. I remember the speaker yesterday, Dan Brown, being surprised with the population of Nigeria that there are less than 30 actuaries. And this statistic is common across Africa. So just under 200 actuaries in all the African countries outside of South Africa, and 1,800 or so in South Africa. So you can see the gap. And perhaps half of those actuaries are in Kenya at the moment, and then the rest sort of scattered across. So there's quite a gap, and basically we seek to fill it. Yeah, I think the slides speak for themselves, and I think the picture there, as we first put it, is to show, it is like a stark picture, but it's actually what we think is a reality. And Ganya's presentation today talking about the importance of having professionals in the insurance sector just belabors the point of the importance of this profession in establishing a sustainable insurance industry. Okay. Oh, sorry, guys. So this is a quote, because as we've started to establish ADA, we found ourselves interacting with other players who don't know what an actuary is, and also, perhaps are not familiar with the insurance sector. So what we have been doing is, aligning the cause to the SDGs and other initiatives. And I think this is one of our key quotes that, protection from risks is the only way out of a world of deepening inequalities and compounding crises. So we try to, integrate the work of the actuarial profession in meeting these sort of understood goals. So the question is, how did ADA start? what we saw in 2023, I don't know how far back to start, but basically the Actuarial Academy of East Africa, which is the concept there on the bottom right, was established by the Actuarial Society of Kenya in, I think, 2018 to really do the same thing that, not the same thing, but a similar concept where you have only a small group of actuaries, you have a large group of students, and a large industry that needs support, right? So the concept had been running for around 6 years, and we presented it at the International Actuarial Association Africa Subcommittee. So let me just stop and ask, how many people are familiar with the International Actuarial Association? Okay, only the people at the front and maybe one, two. No, I think for me it's really important because even before I joined IFOA Council, I don't think I really understood the global nature of our profession. So it's an association of associations, and a lot of the member bodies are members of the IAA, and it gives a forum for collaboration. So within that, there's an African Collaboration Forum, where when we presented the idea or the progress, all the other African associations did highlight that, you know, the problems that we are facing or we were facing in East Africa were similar. And since there was already a working model, why don't we take this and make it Africa-wide, right? So I think that we sort of have to applaud Lusani for that initiative, who was the chair then, and Yesidi, who's not here today. I think she's also going to be part of the presentation, who was the vice chair of that committee. So they gave the mandate to the three of us to go and think through how to make this Africa-wide. And I mean, I am Kenyan. There are 54 countries in Africa. I think 3 prominent languages. Now that we've discovered we hadn't taken cognizance of the Portuguese. So thinking through this concept and how to set it up took probably, I want to say 6 months. I could be wrong. But I think during 2023, we did a lot of that, and it culminated in us having a concept paper which we presented to Africa Re, who is obviously the African reinsurer. And because the ADA needed a home that could be Pan-African, we were really privileged to be able to do that and to get support from the CEO. So I think that's how ADA was born. But it's just to say that it's a collaborative initiative, and it's building off the back of existing success stories. So I think we've seen a lot happening in Ghana in terms of developing their own exams, and this is something that we think is a need within the African context. You know, really pleased that the first candidates in the Unilag session are some of them are in the room, and we're looking forward to them getting their first exemptions. And you know, this is a model we really want to be able to replicate across Africa. You know, Kenya, as I mentioned, has had a trajectory in terms of increasing the number of qualified actuaries, and really the strength of the regulatory effort in terms of training 5 to 6 students every year and taking them to CAS Business School to get exemptions and come back to the market and work in the regulator and then in the industry, sort of has grown more than half of those actuaries in Kenya. You know, sort of seeing Morocco collaborating with the Canadian universities to enhance their faculty, because this is really important for the students. And then we see Rwanda establishing its not first, but its local actuarial association. So there are a lot of needs, and there's, as I said, limited resources. So the question is, how can we consolidate them? And yes, so that's why ADA is the answer. An important one to mention that has really, not necessarily, let's say, proven a proof of concept is the UNDP Milliman Gain Program, which has been running for maybe, I want to say 3 years, could be more. And it's not only focused on Africa, but they've done a couple of studies in different markets. And I think all the roadmap answers they gave show that, you know, we're on the right track as ADA in the pillars that we've set up in terms of them supporting the growth of the actuarial profession in new markets. So yeah, so I think, as I said, we're very excited about it. And talk to us more if you want more details on the concept paper. The principles we work on, I think a lot of them I have talked about, but maybe the main one I'll mention now is collaboration. So we do feel like, I think even in one of the previous presentations where we talked about the insurance penetration, we said people should start competing when insurance penetration is 80%. So whilst we are less than 200 actuaries, I think all initiatives that are trying to develop the actuarial profession are collaborating, and that's what we are doing, working with the local associations and, you know, UNDP Milliman and anyone else who has the same objective. Sustainability is also a key one, because what we've found is a lot of these initiatives that are non-profits require fundraising. So ADA's plan is to actually raise an endowment fund that will be invested for posterity, so that the fundraising is only one-off, and then we actually use those funds to sort of manage the needs of ADA. I mentioned that there were 4 foundational pillars. I really liked yesterday's presentation in terms of what NAS's roadmap is. So all these things are important. Mentorship, last but not least. But I think definitely we see that that need is there in an African setting where the ratio of qualified or experienced actuaries to those training is very low. Tutorials. Since I joined IFOA Council, and we don't always release these statistics, but pass rates are actually quite different in different parts of the world depending on how much support you get, especially in terms of tutorials. And of course, the cost barrier of paying, you know, US denominated or pound denominated exams is something that we need to break the barrier from an inclusivity perspective. Educational development, as we call it, supporting to develop actual study programs and to support universities to get accreditation. So I did all my exams from scratch, but when I first went to Australia and met people who had graduated and had 10 exams or 9 exams from university, I really felt cheated. So I mean, I think being able to give people that that opportunity is great. And then professional development is a pillar we added in terms of ADA assessing the need in the market in terms of the quality of actuarial work we see. So just because someone has qualified as an actuary, you work in Africa, you qualified as a life actuary, you have to do general insurance work, health work, but you don't have necessarily the skill set or experience. So the professional development pillar recognizes that need and fills it. Yeah, so I think that's the concept. I want Yvonne to take you through what's the practice, the proof of the pudding so far. So yeah, thank you very much. Welcome, Yvonne.
I have my own mic. Thank you, Makami. All right. I have to also, it's not that hard, guys. What were you doing? When I start, I'll find out. Anyway, so yes, I'll just talk a little bit about our activities so far, just to see what sort of impact we're getting and hopefully also get you to buy into the concept and join us. So we actually had our first event in October 2024. And that was a fireside chat with the CEO of Africa Re, where we were discussing the importance of actuaries within Africa. So a pro tip to people, if you want to you know, in terms of building resilience, the first thing you should do is get your boss to know what you're doing with your spare time, and then make him also have a foot in the game so he can ensure you're successful. So CEO of Africa Re is my boss. But yeah, so that was the first person that we had. Very, very inspiring discussion, and that sort of kicked us off into what we're doing next. We had our second fireside chat in March 2025, which was with Wai Chiguru, who many of you know. He's been a speaker here. He was in Nigeria before, but he moved on to better pastures, where he is now a CEO of a company in Malawi. So he came to speak about moving from being an actuary to a CEO and the sort of skills that you need in order to do that. But we do other things. There's a mentorship program that's currently going on. We do both group and one-to-one mentorship. For the group mentorship, again, Wise so willingly was our first group mentor, where we discussed, just in a group of 15 people and the speaker, whatever it is the people want to speak about. And I'm not going to tell you. You have to join the next one so that you can know about that too. And then we're starting with our professor training programs, our tutorials, and also Mukami mentioned the analytical foundation program. That's something we're still working on. It will come in a later stage. So yeah, we've been working with quite a few universities as well to try and help them with the accreditation. And one thing to say, like, ACT is association agnostic. So we work very closely with the CAS. We work very closely with the SOA. We have many calls with Andy. We work very closely with the IFOA as well. We have many calls with Irene. So wherever we can help people to ease the path of qualification for people in Africa, we do. So within Nigeria, you know, you know the program with Unilag already. Yesterday was very instrumental with that. In Kenya, we've also been talking particularly with the ASA people to see how they can improve on maybe some of their accreditations there, but also with IFOA, with Zambia as well. So the Zambia used to have accreditation with IFOA, one of the universities there. They lost it, and we're just helping them regain it. So sometimes the professors already know what to do, but they just need that extra push, and we're there to just help them get that extra push. And then, of course, we know about the VE success story in Nigeria, which I'm going to come back to. So one of the courses that we're doing right now is a introduction to property casualty or general insurance basics. So that one was sponsored by the CAS. We've got licenses to a course that was developed in the US. So, you know, we talked about bringing world-class resources to Africa. So it was developed in the US. It was developed for a US audience. But we're going through it with currently a group of 15. And then we have these weekly mentorship sessions where we break down the concepts in case the candidates did not understand, but also we bring it back to Africa. So the very nice thing about this is there are people from all over Africa in it, so they get to share their stories. And I actually wanted to, you know, with here in Nigeria, there are 3 people, they're actually all in the room today that are part of this course. And I wanted to invite one of them, Jennifer, to come and just share her experience. So you guys can see in real life what's happening.
All right, good afternoon, everyone. I'm Jennifer. Oh, wow. It's an honor to be here, to be by Yvonne and Mukami, see my future role models. Okay, so the P&C Actuarial Foundation course. So I do a lot of GI work with EY. Okay, some of my clients are here. I chose to sign up for this course, and it's been amazing. So general insurance is very interesting, you know, because of the variety of risk that we write in general insurance compared to life. And on this course, I have learned a lot. I think one of the very interesting experience for me is learning alongside other Africans, not just Nigerians. So we have South Africans, we have Kenyans, we have Zambians, and all of that. So it's been very interesting. And honestly, you know, when you're working or you're playing in the Nigerian market, at some point you feel like a star girl after some time. And then you take a course like this. And then you see a lot of knowledge gap. I think I had dinner with Yvonne, and I told her, you know, from some of my experiences that in the GI space in Nigeria where, well, for obvious reasons, shortage of actuaries, a lot of people do trial and error, okay? Because the person who is doing life is doing GI, is doing almost everything. So, but with this course, I just saw a lot that's happening, especially in the US market, where, you know, they do a lot of pricing and they have models for pricing, and you see the whole process for rate making, you know, trending and all of that. It's a very, very interesting, eye-opening course. I would advise that as many persons who are interested in general insurance, you can sign up for the next cohort of this course. And it's expensive, actually. I think it's about $8,500 per person. And Ada covered that for me. Thank you.
Yes. Thank you very much, Jennifer. Yes, so they do get the course absolutely free. Thanks to the CAS and Werner Advisory. She didn't have to pay $1,500. Yes. But they are, as I said, there are other people in the room. So we have Innocent as well as Laura, who are also in this course. So feel free to chat with them to just find out a bit more. Gosh, is this 1,500 so interesting? Oh my gosh, okay. But yes, so this is what ADA does. We bring the resources to Africa. So we found people who are willing to pay that money for 25 candidates in Africa. And I'll also say, while you guys are quietening down, I'll also say that it is very competitive. So she did say sign up for the next cohort, but what you need to do is apply and get picked, because quite a lot of people do sign up. It is obviously a great opportunity. Okay. Okay, so I'll talk a bit about our mentorships. I mentioned we have group mentorship and we also have one-to-one mentorship. So we call the one-to-one pathways to success, and the group mentorship is insights and exchange, because that's exactly what you're doing. You're just sharing insights and exchanging in a 90-minute session with a mentor. So we currently have our individual mentorship. It kicked off 2 weeks ago and it lasts for 2.5 months. So we try to keep our opportunities also where we can bite-size, so that people on the ground can also participate. So we definitely need mentors. We have a plethora of mentees. So we want to be able to allow, just the person who's busy in Nigeria to volunteer as a mentor. And actually we do have a few mentors in the room as well. I know Miller's sitting there. He's volunteered to mentor for this as well. So we thank you all for that, but we try and keep it small so that it allows you to put your foot in and serve. And I really liked what Amanda said earlier, that sometimes you're not doing things because you're just doing it scared. So even if you haven't done it before, just do it. We welcome it. And then we're really excited as well. Our next fireside chat is actually going to be in French. Au-delà des chiffres, l'art d'être un acteur impactant. Did I do that okay? No, he's looking at me funny. Anyway, so it means beyond the numbers, the art of being an impactful actuary. So we actually have another actuary turned CEO. His name is Tay Lawson. He's the CEO of AXA Ivory Coast, who will be speaking about this topic. We actually had a call with him before we planned this, and he was very, very passionate about how actuaries should be making an impact in their companies and not just be about the numbers. So really excited to have him. This is a quote: an actuary can be strategic, communicative, and influential. So please sign up to find out how. It is going to be in French originally, but there will be live translation. So you will be able to follow as it goes. So you can scan this barcode if you want to sign up now. But also all this information is on the ADA LinkedIn page, so do check it out. So, again, impact begins where numbers end. So I think it's going to be an exciting session. It's going to be on July the 9th at 3 p.m. Lagos time. And then also, just to give you a flavor of ADA's impact. So currently we have touched people in 26 African countries and counting. But we've also found that particularly our fireside chats are attended by people outside of Africa. So 1/3 of the attendees for our fireside chats are for people outside of Africa, and we've had more than 20 non-African countries from all over. Do you know where Suriname is? No. We've had somebody from Suriname, so all over the place, people are joining. And it also shows that people are interested in Africa as well. So we're really excited about that. And another thing I just wanted to touch on is, I think Mukami or somebody mentioned how we're also, we know there are few people on the ground, so we're trying to draw the resources globally. So all the people that Japa, that have been here, they were here last year, they're not here. We're trying to tap them. And all of you that are planning to Japa, now you know ADA, so be sure to come and sign up to help us. But, the fact of the matter is 2/3 of our mentors come from outside of Africa, which is, wonderful, and that's what we want. We want to bring the resources from outside to Africa to help, because we're so few on the ground. But another great statistic, actually Nigeria, from the African countries, Nigeria is where we have most of our mentors from, which is wonderful. So thank you very much. You guys can clap for yourselves for that. Yes, just going to touch on a few of the successes for Nigeria. So Federal University Dutse is approved for VE. I know, Dr. Naz, you don't know me, but I know you. So, which is wonderful. Again, we worked with SOA to be able to get that done. We realized, trying to streamline the process for people. So if you go to this university, you do these 2 courses for economics, microeconomic theory, macroeconomic theory together will give you the VEE for economics. And then the mathematical statistics course will give you the VEE for mathematical statistics. So again, wonderful. And we're planning to do this across Africa. So just trying to make the process easier for everybody. So the rest of you who don't have VEE yet, yes, Yeside K is the main contact for this, so please reach out. And a few other things. So individual mentorship. 1 in 3 of our mentees are from Ghana, from Nigeria. So I said we had the most mentors from Nigeria, but also the most mentees. I think that is expected a bit, but yes, we can see that people are participating. With respect to our fireside chats, so the last fireside chat where we had WISE, so 1/3 were from outside of Africa, but of the ones that were from Africa, 20% were from Nigeria, so 1 in 5 were from Nigeria. And surprisingly, again, the African country that had the most participants was South Africa, which we didn't expect. I mean, if you give the numbers, yes, but they have a lot of their own resources, so we didn't expect them to join, but they joined. So, there's a place for everybody. And the PNC course, which Jennifer came to talk about, 1 in 5 participants are from Nigeria. But again, you can see the spread of people from everywhere. We've got Cameroon, we've got Ivory Coast, Zimbabwe, South Africa, etc. And we also try to make sure that we have people, we do have people at different levels. It is targeted towards the new actuarial analysts, but we do have people from different levels just to also make sure that the conversations are kept interesting. So we do actually put a lot of thought into designing some of these things, and we always welcome feedback. So yeah, now that you've heard a bit about what we do, how can you support? And of course, we're here to support you. We're here. You can talk to us, and I'm sure a lot of you have already interacted with us. So we have our 4 different pillars. In terms of professional development, we still have to develop quite a lot of content. As I've mentioned, for this PNC course, we're taking a course straight from the US, but then trying to adapt it in real time. But it would be great if we can start developing courses that are African based. That would be wonderful. That's where we'd like to get to eventually. But we're happy to not recreate the wheel. If there's something that exists, we'll take it and we'll adapt it. For the educational pillar, if you have access to resources, or you yourself are willing to help with train the trainer for professors or secondments or access or things like that, and of course accreditation, we're already working with the society sitting here. Please, that is a need as well. For tutorial, we're looking at scholarships to help people for their exams. We're very aware that a lot of people are not sponsored for their exams, but we're very, very happy to hear the announcement yesterday, and we'll hold the FRC to it about reimbursing people for exams. And then, again, we've also been discussing with people about reducing the exam fees for African students and all of that. But we will need tutors. So we're planning to release, have a cohort for the next few exams, and or a new cohort for some initial exams, and we will need tutors for that. So if that's something that you love doing, let us know. For mentorship, we're always looking for mentors. Group, for individual, we currently have a cohort on right now, but there'll be another cohort coming up soon, so watch out for it and please volunteer. And then of course financial. At the moment, Ada's doing all of this. We don't even have a bank account. But we're working on that. But all of this has been, so far it has been donations in kind. But as Mukami has said, we are going to have our endowment fund, and we want it to be sustainable. We want to have that fund and not have to keep knocking on people's doors. So once that starts, please be ready. I know 1 or 2 people came up to me yesterday and said they would love to get their company involved. So we're counting on that. You will hear from us very soon, as soon as we're ready to to receive that money. So thank you very much. These are the key people. I think you've seen Mukami, you've seen me. You know yesterday very well. But we also have the IAA Africa team that supports us and a few other people. So we're really grateful for that. And then my last slide, here we go. So if you want to sign up, contact us, go on to LinkedIn, here are our details. LinkedIn is the truth for us. We don't have a mailing list yet, so LinkedIn is the truth. So if you want to hear about anything, please follow the ADA LinkedIn page, and you'll find out about it. And I'm hoping by the end of today, we'll have 1,000 LinkedIn followers, which is really exciting. So great. So thank you, everybody. Do you have any questions for us? Thank you. Okay, thank you very much. Looks like there are no questions. Thank you.
Oh, please, can we just show a sign of our appreciation with a gift for both of the Mukami and for Yvonne. Thank you. Thank you.
Please don't forget to scan the QR code so we get feedback from you. On the screen, scan it and please send your feedback to the team. So please, every one of us should scan this, and any feedback you want to send back to anybody on the team, this is the channel you use. Please scan the QR code and send us your feedback now. Thank you. All right, let's move on.
Okay, so final words will be the wrap-up from the NAS presidents. And I'll hand you over, Mr. Jolla.
Please, can we give a very loud round of applause for all our speakers so far? So, just a quick wrap-up. Over the last 2 days, we have explored the theme, creating value and building resilience in an evolving economy, with interesting insights and discussions. We started with a keynote address by Dr. Jankara of NICOM, followed by Dr. Olo, who we heard promised us scholarships through reimbursement for exams passed, to interesting conversations and presentations on climate risk modeling and success of family-owned insurance business. Please, Ganu, the front page of this presentation had my picture. Full disclosure, I don't have an insurance company in Nigeria, so I just wanted to point that out. I will. And we have been inspired by the expertise and dedication of our speakers so far. I think conferences like this present us with opportunities to learn, to network, For me, particularly, some of the engagements that I've had, some of the side meetings that I've had has given me more tools to work with, given me things to think about together with the team. And I hope that we've all had the opportunity to interact and network effectively. As we conclude, let's carry forward this knowledge and resilience that we've gained. Let's be ready to adapt and thrive in the face of economic challenges. The Nigerian Actuarial Society will continue to drive capacity development through collaboration with key stakeholders, our educators, lecturers, the Financial Reporting Council, and regulators. I am very, very grateful to have the presence of the president of the IFOA with us, the president of the SOA, and a board member of CAS, who have honored us by attending in person. And I'm also particularly grateful to Tolulope Fadino, who traveled all the way from US to be with us. And a lot of people that have come from the East, that have come from all over Nigeria, from the universities in Dutse, in Kaduna, from all over, in Zaria. I'm very, very appreciative of the journey or the distance that you've had to travel to be here. A special thank you to every one of you. I think someone mentioned yesterday that when you call on actuaries to come for awareness campaign, they don't show up. Sometimes it's not necessarily about not wanting to, but as you see, there are just very few, not even just the qualified actuaries, even the students, we are stretched thin. As you would have heard, there's no room for specialization. You do everything. So for you to have dedicated these 2 days to attending this conference and to supporting us, I say a very big thank you. We've received some tools, calculators, scholarships from SOA, and we've also received commitment from IFA that we may get something in the way of reduced fees. Thank you. May. Okay. So, please, another round of applause for... So, and I'm not leaving out CAS. I do believe that we've had up to 75% discount on exams from CAS, and I think that will remain in place. So thank you very much, CAS. Thank you, Yvonne. Thank you, Steve. I think all of this will help us to widen the net, will help us to build an actuarial profession, and hopefully in a couple of years down the road, we have more people to help us build the resilience that we've all heard about here today. I would like to put a few people on the spot, because without them, we would not have this conference. And I would like Menkoba to come forward with her team for special recognition. They put together all of these events. She is the chair of our planning committee. They're outside. Okay, but Menkoba led the team that put all of this together, and I want us to recognize her again with a round of applause. Thank you, Menkoba. Thank you. Is yesterday here? Okay. Notwithstanding she's outside,
I want to also extend a special appreciation to our CEO, CEO of NAS, Yeside Gbenro, who has worked tirelessly with her team, Juliet, and the others, and the other volunteers to make this successful. As we look into the future, we'll call for more volunteers. This is a volunteer position through and through. I'm volunteering, every other person on council is volunteering, and let's not become what we complain about. A lot of us will complain, oh, we don't have access to this, oh, we don't have study materials, oh, nobody is telling us this, nobody is telling us that. But when we scale through some of those hurdles, we should also try and volunteer and give back. So this is a call to action to everyone in this room. It's not about just teaching people. It's beyond that. There are so many things that you can do for the Nigerian Actuarial Society that helps us and allows or frees some of us up, free some of our time up to pursue other things to benefit the wider community. So we are calling on you, please volunteer, reach out to us in any way, offer your services, teaching, mentoring, delivering webinars in any way that you can support us. Now, on behalf of the Council of the Nigerian Actuarial Society, I want to officially close this conference. However, that is for the conference. Actuaries are known to be too serious. So this time around, for the very first time, we have organized a, is it gala dinner or gala or dinner, or is both? Gala dinner.
The two.
We will not be having gala there, for those of you that know what we mean by that. So we would have a red carpet by 6 p.m. Please don't come as actuaries. Drop whatever actuarial thing you have outside. Come and socialize, come and network, come and let's celebrate one another, our volunteers, those that have made impact to the society. Come dressed to theme. Please don't wear suit and tie. Please, as much as possible, throw it away. Please, we know we are actuaries, but let's surprise people if anybody mistakenly enters this place. Let's surprise them. I don't want them to know that we're actuaries here. So you're welcome. It starts at 6. If you've noticed, no African timing for actuarial conference. Yesterday we started on clock. Today we started on clock. 6 p.m. because I know that we are largely antisocial. Apologies for that. And I know a lot of us will want to get home as soon as possible. So let's start on time so that we can finish on time. I want to leave you with something else from my favorite. At least by now you know who my favorite author is. Again, I'll repeat. I'm trying to recruit more people for him. His name is Nassim Nicholas Taleb. He's the author of Black Swan. And I recommend Black Swan to actuaries, actually. If you've not read it, look it up. It's a very great read. I think I've read it like 3 times. I don't get tired of it. So, Nicholas Nassim Taleb. Again, from his book, Anti-Fragile. He says, the fragile breaks under stress. The robust resist stress. But the anti-fragile thrives because of it. We've spent the last 2 days talking about building resilience and creating value. But what you should know is there is a popular saying, I don't know whether it's credited to Nigeria, but what doesn't kill you makes you stronger. So essentially it's saying that sometimes we get our strength from uncertainty. And you can not only be resilient or robust enough to weather those uncertainties, you can actually grow stronger from it. And as actuaries, there are opportunities that lie in uncertainties. So as an economy, we are going through tough times. That presents opportunity for us to rethink products, for example, to offer. Presents a lot of opportunities. We are talking about climate risk. We have flooding. We should actually take advantage of that. And again, not only be robust, but anti-fragile. Thank you all very much, and hope to see you by 6. Thank you.
All right. Just on the side, the dinner promises to be less risky. Please come not as a professional, come as somebody that wants to have fun. I'm saying this is a warning.
Hi, hello everyone. So the gala night is actually in this room, and the decor lady is ready to set up. So can we please all start moving outside so we can get it all set up, and please be back 6 p.m. prompt. We shall be live and colored, ready for your gala activities. Thank you.
that, I know. He was the lecturer. My regards to you.